just over the last couple of months here will likely continue. Asset managers will likely continue to be a big area of focus. Banking is always complicated with the regulatory elements, but there's capabilities, especially technology capabilities, that I think a number of banking institutions would like to add in, as a number of these firms are really trying to connect with customers in ways that historically they haven't across a broader set of products and services.
Devin, thank you so much. Devin Rinder, JMP Security Senior Research Analyst. And now let's get straight to the Bloomberg Business Flash. Here's Ritika Gupta. Hi, Ritika.
Hi, Francine, Tom. Taiwan semiconductor manufacturing has raised its full-year forecast again. The world's largest contract chip maker posted a larger than expected 36% increase in profit. TSMC was boosted by orders from Apple in advance of the new iPhones. Home sales in Greenwich, Connecticut had the strongest quarter in more than a decade. New Yorkers piled into the town, searching for extra space in the pandemic era. Sales of single-family houses in Greenwich rose 70% in the third quarter. The median price, a little more than $2.1 million. And another sign of the impact of the coronavirus is having on higher education. American colleges are seeing sharp declines in enrollment of new students this semester. A report says the number of first-year undergraduates enrolled fell 16%. Total undergraduate enrollment is down 4% from a year ago. And that's your latest Bloomberg Business Flash. Francine.
Thank you so much, Ritika. Up next, we track COVID-19 with Dr. William Moss. He's Johns Hopkins Bloomberg School of Public Health professor. We'll look at some of the extra restrictions in Europe and in the U.S. This is Bloomberg.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with LACWA.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This This is Bloomberg Surveillance. I'm Francine Lacqua here in London, Tom Keane in New York. Now, we've been tracking COVID-19. We've also been tracking, of course, some of the extra measures being put in place by authorities for some of the big cities, some of the big capitals in Europe. Yesterday was Paris with the announcement of Emmanuel Macron saying that they will go further into not lockdown, but just more restrictions. And then just moments ago, Mr. Hancock, of course, the health secretary in the UK, in the House of Commons saying that London will move into a tier 2 virus alert level. We knew that would be from Saturday morning, but interesting to see exactly how they see this moving and some of the restrictions they can put in place to try and stop this infections rising. This is what else we know from Mr. Matt Hancock of the UK. Now, if you look at a map of the UK, again, it's very different. The Prime Minister tried to give some clarity on Monday, and there are 3 alert levels. Let's call it 1, 2, 3, or medium, high, and very high. And this gives you an indication of what you can do and can't do. Mr. Hancock also saying that no decisions yet have been made on the regions that are in second tier at the moment. So unclear whether they'll go to level 3 or not. Now, to discuss COVID-19, but to also the race for this vaccine, let's go straight to Dr. William Moss. He's Johns Hopkins Bloomberg School of Public Health Epidemiology Professor and International Vaccine Access Executive Director. So, Dr. Moss, thank you for joining us. How can we accelerate the work on the virus vaccine whilst keeping it safe?
Yeah, so there are a number of ways in which we can accelerate this process. And I know that there are some people who are concerned that we're moving too quickly and perhaps not safely. But one way to do it is to combine different phases of the trial. So there's phase 1, phase 2, and phase 3. And what we've done is we've been able to combine phase 1 and phase 2, or phase 2 and phase 3. This helps accelerate the progress. But I think even more importantly, we've had huge investments in manufacturing that allow for the manufacturing capacity to be built up before the phase 3 trials, which demonstrate the efficacy of the vaccine, before those phase 3 trials are completed. And then thirdly, in these phase 3 trials, we're looking to compare how many people get COVID in those who get the vaccine and how many people get COVID who don't get the study vaccine. And in a pandemic, because there are a lot of cases, this can happen much more quickly than outside a pandemic. So this whole process of vaccine development can be accelerated and really be done safely as well.
I mean, in that process, which you laid out so clearly, how much do you worry about, for example, refrigeration? Who would actually get the vaccine first?
Yeah, so there are a couple of issues around deciding who's going to get the vaccine first and then how you actually get the vaccine to them. And we know that we're going to have a limited supply of vaccine early on, perhaps even for the first year after a vaccine is licensed. So there have been a number of processes through which people have thought who should get the vaccine first. And generally, it's what you might expect. It's people who are at highest risk, such as frontline healthcare workers, and people who are at higher risk for severe disease, hospitalization, and death, such as the older adults and people with comorbidities, other diseases that make them at risk for more severe disease.
Doctor, for those of us trying to be virologists but really having no clue, can you explain to us in your simple terms the difference between monoclonal antibodies and actually vaccines, and what is most promising?
Yes, and it's very important for people to understand the difference between the two. So with a vaccine, what we're doing is we're exposing our body, our immune system, to parts of the virus so that our body, our immune system develops the antibodies and other cells that help fight that virus and prevent the spread within our body, prevent disease. With monoclonal antibodies, such as the Regeneron product or the Eli Lilly product, President Trump received the Regeneron product. Those antibodies, which are normally made in our bodies, are given directly. So they don't last as long. They're going to only last a short time, but if you give it at the right time, particularly early in the infection, those monoclonal antibodies can help fight that virus and clear that virus. But those trials are still ongoing. We don't have an approved monoclonal antibody yet. Neither do we have an approved vaccine. So we're still learning how both of these types of products work best in fighting the virus.
Thank you so much, Doctor, for joining us. Dr. William Moss there at Johns Hopkins, and you can be sure to check out VRUS Go on the Bloomberg terminal for the latest information on COVID-19. You can also tune in every day for exclusive conversation with Johns Hopkins experts for an inside look at how the pandemic is evolving. Now, coming up next, Tom Keene, Jonathan Ferro, and Lisa Abramovitz. They'll talk European yields and U.S. politics. This is Bloomberg.
Ada 3 kelompok pengungsi tersebut yang sudah berpencar arah. Kemudian kami dari Polsek Banda Sakti berkoordinasi dengan perangkat desa Kampung Jomblang melakukan upaya pengumpulan secara persuasif serta minta tolong kepada warga. Alhamdulillah warga yang terpecah semuanya berkumpul.
Welcome to That's Debatable, an interactive series on today's most pressing issues. The resolution this time, is it time to redistribute the wealth? 2 perspectives.
Pointing to billionaires and saying we should take their money away is ineffective political strategy.
We have a choice in this country, either great wealth in the hands of a few or a democracy.
I'm John Donvan. Join us for That's Debatable, presented by Bloomberg and Intelligence Squared, Friday at 7 p.m.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Reflationary reopening stage of the economy.
Half the economy is going to have come back, the other half will not have come back and can't come back.
We've never had these kinds of numbers before. We've never had these trajectories.
This time everyone partook of the recession in a way equally.
The failure of both monetary and fiscal policy is that the money isn't getting to the right people.
It all comes back to the Fed. The Fed is very concerned about the outlook.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramovitz. From New York and London, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Equity futures down 34. We are negative 1%. Bonds have bid. This Thursday morning, Tom Keene, it is risk off.
It is clearly risk off, John. We're going to go to Gabriela Santos here in a bit, really to talk about the reframe of investments. The news flow, John, today is absolutely extraordinary, and I know Lisa's going to touch on this. I'm going to get this right out front. Can we all focus a moment on 800,000 claims at 8:30? What's still involved in this nation, in our politics, and indeed in our markets, is a labor economy that, to be polite, is fragile.
And the hopes for more fiscal stimulus fading, Tom Keene, at least ahead of the election anyway. Secretary Mnuchin throwing some cold water over that. We'll talk about the politics in the United States. Need to talk about the new restrictions across the continent in Europe. The economic recovery in Europe, Tom, was already fragile. It was already stalling.
Right.
These restrictions will make that worse.
I'm so glad you bring this up, John. You and I have been going back and forth on this since you got up at 9 a.m. London time this morning. And, John, what I really would want to focus on here is the federal solution and application in Europe versus a state-by-state solution in America. Is that accurate?
Well, they've also got the local issues in the United Kingdom, Tom, and it's the local issues that have really brought London into the equation here. The north of the country was facing much tougher restrictions, and they were looking down to London and asking a simple question. What about them? And the answer is, well, London might get upgraded to Tier 2, which means it will face further restrictions, Tom. That is about a quarter of this economy in the United Kingdom. That is what London accounts for, and we know it's important. For Europe right now, facing PMIs in the Eurozone, sub 50 on services, already coming into October.
Right.
I have to stress, Tom, it's October. It is not November. It is not December. Winter has hardly got started, and we're already having this conversation.
I know we got to get the hour started on radio and TV. John, real simple. Swiss 20-year in 5 massive basis points to a negative 0.313. That's that slowdown, that disinflation tendency in Europe.
Bit into the Treasury market as well. As you pointed out, Tom, 90 minutes away. Lisa, economic data in America.
The economic data, indeed, 8:30 a.m., U.S. initial jobless claims coming out. The expectation is for the information to be messy. California recalibrating some of the ways that they measure jobless claims. But what it will show is a lack of momentum, a slowdown in the recovery, this idea that we are not going to accelerate out of this recession without some additional support, which brings me to Fed speak. We're getting even more of it, John. I know you are hanging on every single word from Bostic, Bullard, Quarles, Kaplan, Barkin, and Kashkari. If they're missing anyone, I'm sure that they will talk tomorrow. I am particularly interested in Vice Chair of Supervision, Randy Quarles. He came out yesterday and said that the Treasury market may be too big at this point for the Fed to step away and will need to have a material role in the functioning of the market forever to come. And then later today, 8 p.m., we were touching on this earlier, these dueling town hall meetings between former Vice President Joe Biden and President Trump on ABC and NBC, respectively. Very interesting. The virtual debate not happening, but now we have dueling town halls with questions about how people will get to view both of them, John.
We will talk about that, no doubt, later in this hour. Looking forward to doing that. Lisa Abramowitz. Let's get to the price action of this morning, shall we? Shaping up as follows. Equity futures breaking down. Big losses over in Europe. At one point, the DAX was down by more than 3%. The S&P 500 right now, negative 30. We're down 0.9%. In Europe, where I wake up, for the record, at 4:30 local time, running by 5. All right, just throwing it out there, Euro dollar 117.20. Down 0.2%.
Gabriela Santos has been trying for 5 years to transfer to London for J.P. Morgan so she can do the Pharaoh Act.
It's a lovely building there. Gabby is welcome. Gabriela Santos joins us now, J.P. Morgan Asset Management Global Market Strategist. Anytime, Gabby, you are welcome in London. You know that. Let's just start with this market. What are you more concerned about this morning? We wake up, fiscal talks breaking down stateside, the other side of the Atlantic, more restrictions in Europe.
Well, thank you, John, for the invitation. In terms of the markets, so I think we're trying to wrestle with two things at the same time here. The first is, as long-term investors, we're trying to position for where we're going over the next couple of years, which is we're in a brand new economic cycle. one that's coming with a lot of monetary and fiscal support that does not seem to be going away anytime soon, and one that's much more regionally diversified for that reason. So we're trying to position early cycle that's overweighting equities, overweighting credit, and keeping it very regionally diversified. But we have to square that with some of these more short-term concerns over the next couple of months around the path of the virus, around when we get more fiscal support. And for that, I think you want to be a little bit less overweight than you normally would. So you think about sizing the positions, and then you still want to keep a certain amount of duration to offset some of the short-term uncertainty here. But overall, we're still thinking of an early cycle playbook, looking through some of the short-term noise.
Gabriela, we oscillate back and forth between technology, large cap. You know the drill. 35% of NASDAQ 100 is 3 stocks. Okay, great. And then we go over to what institutional Wall Street wants to see. Small cap, international. You know the drill. You're living it. When do we get that shift?
Yes, and I mean, to the credit of large cap technology stocks, there is a reason they've done so well. It is logical. They contribute at this point close to a quarter of earnings growth for the S&P 500. That's much more in line with their representation in the index at this point. So very different than the dot-com bubble. They have been doing very well during COVID. We're expecting positive earnings growth for the tech sector in the third quarter. But I think we're all falling victims to a bit of a recency bias here, thinking that we'll forever live in this virtual world. And we just don't think that's the case. We have to believe that at some point we'll be able to leave the virus behind, and we will want to go back to some sort of real interaction at some point in the future. And the truth is, cyclical stocks are priced as if we would never get back to that real life. So we are looking at valuation opportunities in things like industrials, materials, financials, residential and office REITs, really to try to take advantage of that dislocation, thinking about the next couple of years.
Residential and office REITs, that is brave, Gabriela Santos. I'm wondering, you want to elaborate?
I do.
Okay, carry on.
Because I do think it's a great example of this recency bias. When we look at the REIT sector, the only thing that's really done well this year is industrial REITs, going along with the e-commerce theme, because there's been so much spending on things like warehouses, going along with the tech theme, with digital storage. And then you have every other kind of REIT in deep negative territory. And I think you have a sweet spot there with residential and office, where it's not an existential threat, unlike retail REITs. And you do have the ability of people to eventually go back to the office. We are very big proponents of office culture. We think that's very, very important. Maybe you have a more flexible arrangement, but it's not something that you write off altogether. And remember, as a business, you still need to have availability for all of your employees to come in. So I think that's a great example of a dislocation that's happened beneath the market that we don't think is justified.
Gabriela, so many people have come on the show and they talk about how financials feel underpriced, especially given the fact that we will eventually get a recovery. They just reported earnings. JP Morgan, your bank, beat expectations. So did a host of other banks, and yet their shares have gotten still beaten up. Why?
Yes, and I think that's an interesting point about the uniqueness of this cycle versus previous cycles. We have fresh in our minds last cycle, the financial sector was really at the epicenter, an existential threat, and that's just not the case this time. The trouble's elsewhere in travel, leisure, and hospitality. So it's not an existential threat for the financial sector. What we're missing is really a catalyst to get stock prices off of their still bear market territory. We were thinking that the decrease in loan loss provisions could be that catalyst, because it signals the potential for a bottoming in earnings for the big banks. I think the trouble is just the messaging around that being still a bit uncertain and a bit dependent on the path of the virus and more fiscal support. But once we get more visibility, then you should have a recovery in the path of financial stocks.
Gabby, we've got to leave it there. Looking forward to seeing you in London soon. Gabriela Santos.
Looking forward to it.
Morgan.
Thank you.
Thank you. Let's get to the price action this morning, this Thursday morning, shaping up as follows. Your equity market looking a little something like this, with futures gapping lower, down 35, we're off by 1%. The equity pain, though, is really focused in Europe. If you look to the bond market, Treasury's breaking 70 basis points. I know that'll get your attention, down about 2 or 3 basis points. But the DAX, Tom, the DAX off by 2.8% now. It was down 3% and change earlier. These restrictions in Europe really going to add to the lack of momentum this economy already had a month or so ago.
John, I just did, and folks, I'm not going to go into this because of time. Lisa's going to unplug my mic, but John, you're going to, John, there you go, muting me again. Okay, I just did a 2 standard deviation study of SPX and DAX, and all you need to know, folks, is Standard & Poor's 500 is just barely off its recent highs, and John, to your good point, the DAX is really, really taking some damage, well under the 50 percentile mark on that study. Was that okay,
this international rotation, it was great. We've got to get more specific about this international rotation, Lisa. It's not just about everything else ex-US. I think you have to be looking at Europe versus Asia right now. On a morning where we're talking about further restrictions across the continent, we're also talking about Hong Kong, Singapore, opening up that flight corridor a little bit more. And Lisa, that's the story, the divergent story between how Asia has handled this, how Europe is handling this, and how America is handling it as well.
And that's the reason why you're seeing Chinese stocks at record highs. That's the reason why you saw incredible demand for the latest U.S. dollar bond out of China. That's why you see so much money flooding into China despite the increasing tensions between the U.S. and China. It raises a question: how long? How much does this have legs? And how much is this just an indictment of the failures, frankly, of the U.S. and Europe in containing the virus?
The question of this evening, what's on CBS tonight? Does anyone know? Tom,
Big Brother.
You're really going to go
Brother was in my 6 o'clock skip. I'm watching
Big Brother.
Big Brother is a show where you're sequestered in a house and you have no TV and you can't watch campaign ads of Biden or Trump.
90 Day Fiance.
It's very successful.
He's going to watch 90
Started in the Netherlands.
Ms. Chen Mundus started in the Netherlands.
Endemol.
Yes, Julie Chen Mundus.
Very, very cool. I'd love to see you on Big Brother. That would be great.
Les
I'd like
wanted
to
me
see
to
you
do
get
it.
very far in Big Brother too. Did he?
Look at those markets.
Look at those markets.
I may do 90 Day
Coming up.
Fiance. What do I know?
Steve Weidinger City. That might not be your choice.
Really?
This is Bloomberg.
That might not be my choice. Good morning, Mrs.
With the First Word News, I'm Rishika Gupta. The chances of Congress passing a pre-election stimulus are all but gone. Treasury Secretary Steven Mnuchin is blaming politics. Mnuchin says Democrats don't want to give President Trump something to brag about in his campaign. Democrats say the White House never took the need for another stimulus seriously enough to push for compromise. Senate Democrats are all but powerless to keep Amy Coney Barrett off the Supreme Court. So they used their final day of questioning at the confirmation hearing to grill her about statements made by President Trump. Barrett declined to answer whether the president has the right to delay the election and an absolute right to pardon himself. Another sign of the impact of the coronavirus is having on higher education. American colleges are seeing a sharp decline in enrollment of new students this semester. A report says the number of first-year undergraduates enrolled fell 16%. Total undergraduate enrollment is down 4% from a year ago. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
I don't care that there are others who are bigger. That's not the point. The point is, are we generating the returns we need for our shareholders, and are we providing the clients with the opportunity that they need for the best product out there?
James Gorman of Morgan Stanley weighing in on the recent deal-making he's been up to through 2020. Those earnings from Morgan Stanley just around the corner from London and New York this morning. Good morning. Alongside Tom Keane and Lisa Abramowitz, I'm Jonathan Ferro. Little bit of risk aversion to kick off your Thursday morning. Equities bleeding lower, much lower in Europe. Equity futures on the S&P 500 down 35, call it 36, and negative a little more than 1%. In the bond market, a break of 70 basis points, 0.6975 is your yield on a 10-year. And in foreign exchange, dollar strength against the weaker euro, and it's the weakness in Europe that is of concern for many of you, I know. Euro dollar 117.13, Tom. That currency pair down by around about 1/3 of 1%.
And Euro Swissy one benchmark there going to go through 1.07. That's a huge deal, folks, to get a 1.0699 on Euro Swissy. Strong Swiss franc would speak volumes about the weaker euro, John mentions. Right now on Morgan Stanley, and certainly the success of Fortress Gorman relative to Goldman Sachs, but really relative to many. Allison Williams joins us with Bloomberg Intelligence. Shonali Basak on in a bit here on the Morgan Stanley earnings. Allison Williams, let me cut to the gossip, which will be on the conference call. Does Morgan Stanley need to be an international bank to keep the Gorman plan going?
Well, I think they do, and they are, but the bigger story, of course, is the shift towards wealth and asset management, gotten dramatically bigger by the two big deals announced this year. And I think what we're going to be listening for today is, what are the changes in the sort of pro forma expectations now that E-Trade has closed? If you recall, they announced that deal in February before the pandemic really took hold. And since then, actually, E-Trade has done pretty well in terms of new accounts, client assets, very strong. And so how does that change the outlook for the combined business now that that deal has closed?
There's also a question, Allison, after Goldman Sachs reported their earnings and they came out beating expectations significantly on the bond trading side. The rivalry that Morgan Stanley and Goldman Sachs has, who is going to win? What do you expect when we get these earnings from Morgan Stanley?
So the rivalry, and at the end of the day, they're both very strong in equities. So it really, I think, comes down a little bit to bragging rights, but it's going to be close. And it was notable that Goldman Sachs in the first half returned to the leadership for the first time in many years, or many halves. And so over the long term, market share is important, right? Because obviously you do want to be competitive in your business, and the U.S. leaders, it has helped them over time. In fact, in over periods where their overall revenue pool has declined, they've actually grown trading revenue by those share increases. But for equity trading in particular, Goldman had a blowout quarter. The only really one area where they sort of came in about in line was equities trading, and they're really just a few tens of millions short of what we're expecting for Morgan Stanley. So again, both probably strong this quarter, but we'll see who gets the bragging rights.
And Allison, none of it matters because financial.
Okay, ladies and gentlemen, I'm placing a new order. Buy euro at 117.13.5. 117.13.5. Okay, order placed. As you can see, I placed stop on profit for order we had before. You can see from our ticker, we sold short euro at 117.44, and stop on profit I placed at 117.29. Okay, hope everybody understands how it works.
Have done better relative. In general, I think for the financials, what's difficult is the big amount of uncertainty out there.
Yeah.
And so this quarter, as I believe you said earlier, the provisions are coming down, but no one really cares about that because there's still so much uncertainty, and because the banks are talking about charge-offs not peaking until the end of next year under a base case scenario. They've provisioned for that, so they've set aside money, and so in a base case, it looks like they won't have to add any more reserves, so the earnings won't get hit more. But I think it's very difficult with all that uncertainty out there. You know, stocks don't like uncertainty for the stocks to move further. And finally, I should just note the dividend issue as well.
Allison, this is an important question. Long ago and far away, in the time of Allison Williams and, say, Brad Hintz at Sanford Bernstein, there was understanding that even if Morgan Stanley and Goldman Sachs had good quarters, you couldn't bank it on a persistent basis. Maybe to use the overused word right now, resilience. Is their cash flow now newly persistent and resilient where you can price that?
Okay, I opened new position for euro. It's long at 117.13.5. Okay, right here, position open. Move it higher.
And asset management, Goldman doing the same with some of its businesses, what they refer to as more durable, more recurring revenue. So you might make money every single quarter in trading, but I think because as an investor, when you value those earnings, because they can go away overnight and they're transactional, you're just going to give them sort of less credit for that. And the fact that, you know, the two stories this quarter, so provisions are lower, that's not repeatable as we just discussed. Trading, also a really big driver, and investors feel like that's not repeatable. And so I think that's why, despite the fact that we're getting these big beats, it's not, it's not necessarily being extrapolated for the future. One important point for Goldman Sachs, one benefit of their blowout quarter is the huge build in capital. So they were very close to their ratio. They weren't quite where they needed to be as of the new October requirement, and they jumped over that with a huge build in capital this quarter. Morgan Stanley, as I said, I think that the longer-term story is really the shift towards wealth and asset management, but still, investors are going to want to see them keep pace in trading. So they might not necessarily extrapolate that, but they're going to look at how does Morgan Stanley perform against the banks and want to make sure that they're keeping pace.
Alison, brilliant to catch up this morning. Appreciate your time. Alison Williams there of Bloomberg Intelligence on the big bank earnings this week. Still waiting for Morgan Stanley. Shanali Basak of Bloomberg, our Wall Street correspondent, standing by to break those numbers in just a moment. We need to check in on this market for you.
Yep.
Every 5-10 minutes, just to keep you up to speed this Thursday morning. Claims are about 1 hour and 5 minutes away in America. It's an equity market that breaks down, but really the epicenter for it is in Europe. Futures down 33, negative 0.9%. In Europe, down hard, much harder. Euro dollar 117.13. Dollar stronger against everything in G10, as Tom points out. Euro Swissy one to watch. a stronger Swiss franc in the mix. And in the bond market, Treasury yields bleed lower, down 3 basis points. On a 10-year, your yield is 0.6975%. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. This is Bloomberg Surveillance.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From London and New York, this is Bloomberg Surveillance. For our audience worldwide, we're live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Thursday morning, 2 hours away from the opening bell. Your price action looking a little something like this on the S&P 500. Breaking down on equity futures, on the S&P, we're down by 32 points. We're down by 0.9%. Euro dollar 117.13. In the bond market, yields come in around about 3 basis points to 0.6991%. So a break of about 70 basis points. That's the price action. Morgan Stanley numbers just coming out. I want to cross over to our colleague, Shanali Basak, who's alongside Tom Keene in New York to break down the figures. Hey, Shanali.
John, really clean numbers over here. A FIC beat, equities beat, and EPS beat. So you're seeing clear numbers from Morgan Stanley. Of course, they're the #1 equity shop on Wall Street. So we know that they had been playing tag with Goldman Sachs in the most recent quarter there. The question is, do they have the pipeline in investment banking like Goldman Sachs said they had? The next 3 months will be critical as we see a choppy time in the markets and as we see the rush to liquidity continuing on in the markets.
Shonali Bassett with the latest numbers. Shonali, stand by. We'll catch up with you a little bit later in this segment. I want to turn to the price action at the moment. Down 0.9 on S&P 500 futures off the back of more decisions out of Europe to lock things down a little bit more. The headlines across the continent negative, the reaction to them by policymakers adding to concerns of market participants. Chad Thomas joining us now out of Berlin. Good morning to you, Chad. What are we hearing from Germany, from France, from Spain, from Italy, from the UK? And what's the difference between the approaches?
Hi, John. Well, we're hearing leaders across Europe sounding the alarm in the last 24 hours. We've seen several countries, including Italy and Germany, reporting record cases. And of course, French President Macron announcing this curfew for cities across France, including Paris. In Germany, we have a situation where Chancellor Merkel is urging state leaders to have an even stricter lockdown than the one that they've agreed to last night. But she's meeting resistance from these leaders. You know, Germany is a federal system very similar to what viewers in the U.S. would think of in terms of the federal government versus the states. And the state leaders here in Germany are resisting some of these measures that Merkel is pushing for. For example, disagreeing with her on measures such as restricting travel within the country. And it really all boils down to the economics. Everyone's very concerned here on the continent about another lockdown and what that could mean, you know, not just for the health of people here, but for the economy as a whole.
The local pushback is something we saw in Spain just a few weeks ago. We're seeing in the United Kingdom play out in the last 24 hours, with perhaps the exception of Sadiq Khan, who's asking for it, which is a unique situation right now for anyone in the local authority. But what I want to know, Chad, is whether we're seeing the outcome here, the result of a poor adherence to social distancing and mask wearing, or just the very fact we're moving into the colder part of the year?
I think, John, it's a little bit of both. What's interesting is the German health minister, Jens Spahn. He has said what Germany needs is not necessarily more restrictions, but people to adhere to the restrictions that Germany has already in place. And in Merkel's appeal last night, when she held this very late night press conference, she basically said people need to wear masks. They need to wear them in public where there are a lot of people, and they need to adhere to the social distancing. We're going to be hearing, by the way, from Jens Spahn in just about an hour, speaking exclusively to us here at Bloomberg, talking to our colleague Matt Miller. And so we'll be hearing more on that from him a little bit later this afternoon.
Chad, thank you so much. Chad Thomas in Berlin on the movable feast of pandemic news on the continent of Europe. Right now, Terry Weissman with us from Macquarie, Director of Global Currencies, also macro strategist at Macquarie, and this off work at the Federal Reserve years ago, and of course, legendary at Bear Stearns on EM. Terry, I want to go to John's point on a Europe flat on its back, to the great pandemic divide, which is a Pacific Rim which seems to have its act together, and the Western world that does not. How does that play out in, like, Gita Gopinath GDP, and then on to how does it play out in investment opportunity?
Look, China was first into the coronavirus pandemic and crisis. It seems to be the first out. If you look even, for example, at its export numbers, they seem to be rebounding. But there's a bit of another story here for China and Asia, and I think this is the fact that they're able to actually take advantage to some extent of what's happening in the West. Think of China, for example. Its manufacturing exports have done exceedingly well in the last few months, and we have to attribute at least some of that to the fact that they're exporting things like personal protection equipment, masks. They're exporting the electronics that the West is going to use to overcome or actually circumvent some of the more adverse aspects of this coronavirus, including things like working from home. So it's in an odd turn of events. Not only is Asia coming out of this first, in part because of their respect for conformity and rules, let's say, in their cultures. But they're also, in some sense, taking advantage of the fact that the West is in the dumps right now by boosting their exports of things that the West desperately needs at this point in time.
Terry, how do you trade this? Because we know that the PBOC, that China's government, has a pretty strong hand in the movement of the yuan, of their currency. So how do you sort of get ahead of this dominance that we're seeing from China?
Well, if what you're suggesting is that the Chinese do not like currency volatility, I wouldn't stand here and say that there's no way to play FX. You can still play through the forward market. You can still play it through optionality. You can make a case, for example, that up until recently, we've seen a massive amount of investors, offshore investors, Western investors, who are in China, buying the dollars against the yuan on a forward basis to hedge against the risk of one day seeing a devaluation in the yuan. They've been buying optionality in dollar yuan to make sure that they protect themselves against an eventual devaluation. Let's say that were to take place because of worsening conditions and terms between the West and China. But now, with volatility prospectively going to dampen there, with a Biden administration prospectively in the U.S. Being having less animus towards China, especially with regard to tariffs, the way you play this is by betting on lower volatility going forward. Hedgers are going to unwind those positions. Volatility, implied volatility in dollar yuan is going to fall. Forward points are going to fall. They're going to compress. That's going to be a sign that there's going to be more safety in China. And yes, there are ways to play more safety through the markets, for example, just through those means. Another way to do it is simply to buy corporate bonds in China. They're yielding quite a bit. 10-year sovereigns are yielding ahead of 3%. If you believe risk in Asia is coming down, those are still good bets.
Okay, so what about over in the U.S.? There's this feeling that you should go into riskier credit here as well because the Fed has your back and that they'll continue to ease because they have no choice. Is that a valid bet, or should people just go buy Chinese bonds?
I think for those business models that are viable, yes, that's a valid bet. In fact, the Fed is unlikely going to go out and buy the junk bonds of companies and sectors that are not viable, right? So if you were talking about airlines, if we're talking about restaurants, I would avoid them. But for just about everything else, I do believe the Fed has your back, yes.
Tom, we've got to talk about this bond market at the moment, just looking at Treasury yields breaking down by about 3 basis points. All the talk of fiscal stimulus, and we can't get out above 70 on a sustainable basis. A break is 70 basis points on a 10-year again. And I looked at Germany, Tom. Negative 63 basis points is your 10-year in Germany right now. Core government bonds still looking firm.
And again, that's a 5 basis point move. And Stan Fisher over at BlackRock, of course, with a few other attributes of his career, would say you take 5 basis points and divide it by that statistic. It's a huge percentage move that we're seeing in Europe. Terry Weisman, that really speaks to the markets speaking. Are the markets telling the institutions what to do? Is the market telling the Fed and other central banks what to do?
I think so. I think certainly it is the case that the market is disappointed with the fact that the Fed has not articulated a more concrete policy path that conforms better to their new average inflation targeting strategy. I think the market would have wanted to see the Fed commit itself to something at the last policy meeting. Now, maybe the Fed was simply just preserving its ammunition for November 5th. Maybe on November 5th, which is right after the U.S. election, in the possibility of a situation where we find ourselves with a lot of uncertainty with regard to the presidential election outcome, the Fed will do something. But yes, I agree. The market is trying to tell the Fed, you have not done enough yet. You need to be more articulate. You maybe need to set up some interim inflation target numbers above 2% to make a stronger case for pursuing the average inflation targeting policy. I think that might...
Terry, never mind the Fed on November 5th. Let's get to the ECB on October 29th. Let's get to the ECB on October 29th. For the European Central Bank right now, we're reporting this morning here at Bloomberg, our team over in Frankfurt doing some great work, reporting that the ECB aren't in a rush to add stimulus at the next meeting. 2 weeks out from now, the PMIs were already negative if you look at the services PMI for the continent. The restrictions they're adding this morning on some of the biggest economies across Europe, then add in the UK as well. For the ECB, Terry, what's next?
I think what's next for the ECB is more structural than pinpointed, right? I mean, they're going to have their own strategic review early in 2021, and I think they may adopt their own version of average inflation targeting at the ECB. I think that's where the eyes are pointed to right now with the Governing Council. There are still some members of the Governing Council that are opposed to this. But I think it will happen at some point in 2021. I think the October 29th meeting is a bit too early to anticipate or expect new policy measures. However, I would be concerned about the European economy. We are going into the Christmas season, obviously, and if the coronavirus caseload continues to rise, you're going to get a terrible Christmas season. And then at that point, people will start wondering if the year-over-year GDP numbers as of Q4 in the Eurozone, fall below that -5.5%, -5.6% threshold that the consensus is looking forward to right now. That's year over year, of course, on GDP.
2 weeks away from that ECB meeting at a time where a week feels like a year. Terry Wiseman of Macquarie, thank you, sir. A little bit earlier this morning, about 10 minutes ago, we had numbers from Morgan Stanley. The stock in early trading down about 1/3 of 1%. I want to touch base with Shanali Basek for more. Hey, Shanali.
Hey, John. Yeah, if you look a little deeper into the numbers, you have a 24% pre-tax margin in wealth management, and that is lower than what James Gorman likes to be posting. There will be questions about that on the call on what's driving a lot of that weakness, especially as they're doubling down on the wealth management business. This is the first earnings period in which they actually own E-Trade. That acquisition closed a couple of weeks ago. There's also some weakness in some investment banking businesses, a decline in fixed income underwriting. You still saw higher fixed income trading, albeit lower of a rise than we saw over at Goldman Sachs. We'll have questions about what kind of market share we think they're gaining, but right now they're standing in between JP Morgan and Goldman Sachs.
Wrapping up earnings on Wall Street, Morgan Stanley unchanged in early trading. Coming up on this program in the next hour, what a timely interview with Vitor Gaspar, IMF Director of Fiscal Affairs. From London and New York, alongside Tom Keane and Lisa Abramowitz, I'm Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Don't count on another pandemic stimulus package before the election. House Speaker Nancy Pelosi told MSNBC the two sides are far apart on worker safety, school funding, and a strategic testing plan. Meanwhile, Treasury Secretary Steven Mnuchin says Democrats don't want to give President Trump something he can brag about in the last weeks of the campaign. And Democratic presidential candidate Joe Biden raked in a record $383 million last month. That broke the mark the Biden campaign set the month before. The massive fundraising hauls have helped Biden and the Democrats reverse President Trump's one-time financial advantage. In France, President Emmanuel Macron has imposed a curfew in Paris and other major cities. That extraordinary step is part of a series of new measures aimed at containing the spread of the coronavirus. Rising infections in France have started to fill up hospital beds. Hyosung Lee is now the sole CEO at Carlyle Group. He recently sat down for his first major broadcast interview since taking over at the private equity giant. He discussed a wide range of topics, including why retail money represents huge potential. And we'll have more of that interview with the Carlyle CEO throughout the day. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
sometimes you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The second half will be a lot stronger than the first half in China. We're heading to what we call the golden season of auto sales.
We are very confident, we're going to have another big growth, 2021 versus 2020.
We did not see people kind of holding back.
Chinese customers are into, right now, buying individual mobility.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
I'd say at this point, getting something done before the election and executing on that would be difficult, just given where we are in the level of details, but we're going to try to continue to work through these issues. And again, from our perspective, we could have immediate help to many important parts of the economy now.
What's changed? What's new? Apparently that's news. Secretary Mnuchin there, Treasury Secretary, weighing in on fiscal talks, hopes dashed for a deal before the election. I have to say, Tom, I've been so confused by all of this. Many people have. It's been the same story for the last 3 months. Just because the talks are happening doesn't mean there's any progress around much at all, and I just don't think there's been enough progress whatsoever. And once again, where's Leader McConnell on all of this? Was any deal in and around $2 trillion going to pass the Senate? I had no indication of that whatsoever for the last month.
I think you're right, and it's all about politics. And, of course, there's a tip point, which I don't know, John, a number of days ago where it's too close to the election. As we mentioned yesterday and even on Monday, there has been a shift in the winds. No surprise of that, of our political rhetoric. Just to quote the president yesterday in Iowa, he was ranting against elites who, quote, live behind gated walls. They flooded your communities with illegal immigration, deadly drugs, MS-13 savages that assault, rape, and murder innocent Americans, and on and on. Kevin Cirilli here to translate, our chief Washington correspondent. Maybe we won't hear that on ABC tonight, but Kevin, what are we going to witness on NBC with the president in a self-town hall? Are we going to see the energy of the first debate? Are we going to see what I just quoted in Iowa? Or are we going to see something different?
No, I think you're going to see something different. I think a town hall format traditionally has been better suited for both of the candidates. I don't think that the Trump campaign views it as a viable strategy to try to, blow up another debate or town hall at this particular moment in the race. They clearly have seen the negative repercussions of that. For the Biden campaign, it's, don't do any harm, do no harm. That's really their strategy because they're leading. And I think, really the president's rhetoric is really tapping into the populist unrest that helped form his coalition back in 2016.
Kevin Cirilli out front a few days ago, folks, lighting up on North Carolina. Everyone else is caught up as well. The information in those polls, Kevin, are interesting in North Carolina. Can you extrapolate that energy to other battleground states?
Yes, and I think you can look at Iowa, where Teresa Greenfield is giving Senator Joni Ernst a run for her money. And the president, of course, traveling to both Iowa and North Carolina this week. So the question for Senator Ernst and Senator Tom Tillis of North Carolina, the Republican incumbent, is do you separate yourself from President Trump, or do you link yourself to him and pin your hopes on him? And that's it's interesting to watch Senator Ernst continue to double down with President Trump, but meanwhile, Senator Tillis taking a slightly, albeit slightly different approach, still with the president, but not afraid to make direct appeals to suburbanites who are voting Biden at the top of the ticket.
Kevin, every day there's a new poll and there's a new story, and I think the poll of the last 24 hours that got everybody's attention was that outlier, and I stress outlier, Quinnipiac poll in Georgia. Can you speak to what's going on there?
Well, with regards to Georgia, I mean, this is a state that Democrats have really wanted to pick up and win for quite some time. And so, you know, again, if you look at the semblance of there being a potential blue wave, you know, that would bode well for Biden should he be able to pick up Georgia. But I think, you know, I mean, who knows at this point? I think
for the place to stop for my euro position, short position that I opened at 117.12.2. The stop placed at 117.10.2.
If we don't get a bill in the lame duck session between November 4th and the end of the year and the beginning of next?
Well, that's a really good point, because I think right now the assumption that Speaker Pelosi is working with, that she will be emboldened with more with a mandate, so to speak, from voters just around the corner from the end of the year. She's also looking. She's also likely, you know, looking at lawmakers who will have been voted out of office, who could be easily pressured into getting on board with the stimulus. But, you know, there's a lot of assumptions, and that's a lot of assumptions to make in what has been an incredibly volatile year in Washington, D.C. with policy. Should Biden win, I think you would definitely see another stimulus deal in the first calendar quarter of next year. But should Trump win, I think even he has said he wants more stimulus. So again, I just keep going back to the notion that even Leader McConnell wants couple of $100 billion worth of stimulus. So they all do agree on that, and I think they're just waiting for more clarity from the electorate.
Meanwhile, we have, I believe, 19 days until the election. Can anything change the trajectory currently?
19. You know, yes, I'm going to say yes. I think that you've got another debate. You've got town halls. You've got a ton of public appearances. I think that, you know, look, I mean, after 2016, I'm not going to predict anything. But you know, I do think that it will all come down to, can the Trump coalition really motivate voters to get to the polls? And I will tell you that there is a palpable anxiety amongst Democrats that I speak with. I spoke with one last night, and essentially what they're saying is they lived through 2016 where they all thought they had it in the bag, and then obviously they didn't get the outcome.
Kevin, you've been great on this, and the New York Times has that grid that they've got showing, you know, comparing now to 2016, and it's been a real staggering change. Kevin, I want to know, who's advising the president? Is this Mr. Kushner or Mrs. Kushner? Or, you know, he seems so alone when I look at the quotes in video or in print. It seems like he's almost doing it ad hoc.
I don't think he's alone. I mean, what does that mean? He's like, he's not surrounded by anybody? I mean, no, he's not alone. I mean, I think,
Kevin,
but seriously, I'm not pushing back. I'm doing it politely, right?
Like it.
You know, I mean, but because, I mean, he's not like, oh, he's all alone. Like, no, I mean, this is Bloomberg. This is Bloomberg, right? So, look, I think he's getting advice from Ivanka, from Jared, and look, I think Rudy Giuliani really does have the president's ear from a campaign
Did Rudy
strategy.
Giuliani assist the president with the article in the New York Post that people have respect for, but are carefully analyzing?
Yes, absolutely. And I thought, and that was my big takeaway. And you and I talked about this on radio, Tom. I think my big takeaway was to see the alignment of Steve Bannon with Rudy Giuliani, and that's a strategic shift. And in
That's going to get the suburban voter. Steve Bannon and Mayor Giuliani are going to get the suburban voter.
Kevin, you only have another minute. Don't worry.
It's not what I'm saying. What I was saying was, I think in covering the Trump campaign, the different alliances amongst some of the inner orbit and the inner circle is fascinating to watch that shift. Amazing. And there is a clear relationship that has developed between Steve Bannon and Rudy Giuliani. From their perspective, you know, we'll see how that's executed.
John, this is phenomenal. Kevin, I've just figured it out.
Enjoying that.
John, you have an inner orbit, don't you?
Most media operations do hostage training.
Tom, am I inner orbit? Tom, am I inner orbit?
Yes, inner orbit.
Thank you.
No idea what the last couple of minutes was. Kevin, good to see you, sir. Don't know if you'll be back tomorrow. From London and New York, this is Bloomberg.
has been interrupted. Uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it'll take you interesting places.
We're clearly going through some very unusual times and, you know, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacqua.
We are now fully in this reflationary reopening stage of the economy.
Half the economy is going to have come back. The other half will not have come back and can't come back.
We've never had these kinds of numbers before. We've never had these trajectories.
This time, everyone partook of the recession in a way equally.
The failure of both monetary and fiscal policy is that the money isn't getting to the right people.
It all comes back to the Fed. The Fed is very concerned about the outlook.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast on Bloomberg Radio, Bloomberg Television. Welcome all of you worldwide. In Europe, with the challenges there, we'll get to that in a moment. And across this nation, in this hour at 8:30, claims, all of us waiting to see that. It has been week after week at an 800,000 level, even up towards 1 million, of course, a number of months ago. And the news flow is just simply extraordinary. John, you have been way out front on the distinction between this virus and pandemic on the continent of Europe over to the United Kingdom and the difference with the United States. How urgent is it for Mr. Macron, Chancellor Merkel, and Prime Minister Johnson?
Becoming much more urgent, and the difficulty they're having, Tom, is localizing the effort, because many people in the parts of the country that face tougher restrictions are asking the question, what about everyone else? And that was the story here in the UK, as London now gets upgraded to a new tier and faces new restrictions. We're seeing something similar play out in Spain, in France, in Germany, and now Italy too. And as we get deeper into the winter, it's not just about the caseload. I think they're much, much more keen to emphasize and highlight the hospitalizations and healthcare capacity, and that's the reason for the new restrictions through many of these countries in the last 24 hours.
Partly folding over into the markets. We'll do some data here along the way. Futures negative 39, Dow futures negative 304. The VIX was near two big figures, now 27.68, showing the risk-off feel. But Lisa Abramowitz, I want to go to you on one single Bloomberg chart I saw yesterday, thanks to Zero Hedge on that. And in your world, it is stunning how the high yield interest rate or yield has come in towards full faith and credit. It's just amazing the velocity of that lower yield in the high yield space.
Investors are going into junkier credits. The junkier, the better, basically saying that the ones that have filed for bankruptcy are already out of the index. The ones that are remaining probably will survive. We probably will get an additional round of fiscal support. And frankly, if the Fed has your back and they are buying bonds and they're going to keep rates this low, you might as well go to credit. I mean, we heard this yesterday from Andrew Sheets. Spreads are too wide. We need to tighten those up.
I mean, okay, but John, this is important as you go into 5-hour planning for the real yield tomorrow on Bloomberg Television World Wide. I mean, John, there's the bet. You see it in the Italian yield, this yield, that yield, and the other. All my radar is up over the certitude of buy the piece, lower yield.
What do you hear this morning? Almost immediately, people talking about more from the Fed, more from the ECB. You'll hear a lot more about November 5th, October 29th. The more we start to face these restrictions across places like Europe, Italy, Spain, France, the UK, Germany, the pressure starts to build on policymakers again. And I think fiscal policymakers did a lot. We all know that. That's a fact. But where's the appetite to do it again? It's not there. It's not there. They're worried about damaging this economy, and they're worried about the price tag that comes with it. That's the difference between now back to March, not just the healthcare data, but it's more about the appetite to offset the pain of telling people to stay at home.
I want to do this quickly, John, before we get to Steve Whiting of Citigroup. Riley just emails in from St. Louis and notices West Texas Intermediate. Plunging is the only word for it right now. 39.53 down, $1.52 on West Texas Intermediate, a 3.7% move. We'll try to get that chart up for you here. In the control room, they're like working on the intraday on West Texas Intermediate. We'll get to it in a moment. It's a plunge in oil. That's something that Stephen Whiting looks at. He's with Citi Private Bank, of course, our chief investment strategist, and we're thrilled he could join us today. Stephen, what is this risk-off signal right now? I mean, we've had a pretty good roll of it over the last number of weeks, and suddenly risk-off. Is it a tension that can build?
Well, it's been there in the sense that we've had a high level of implied volatility in equity markets, but underlying cash markets haven't done very much. We had a fairly meaningful setback in September for tech stocks, but let's just face the fact that we have a good deal of policy uncertainty out of the United States. We have COVID, which is not under control in the United States or in Europe, as you just heard, and we are not seeing an immediate policy response to this. So you put all of these three things together, and it should be an environment where we should see wider ranges, and we should see periods of significant risk off within a scenario, I think, of us getting eventually past this COVID.
John, you've got to look at it within the negative yields of Europe. I mean, the dynamics there between the Germany 10-year, the Germany 2-year, there's some, the gamma is the phrase that pros use. The acceleration tendency of the yields, John, in Europe is something.
Negative yields all the way out through the curve, a 10-year negative 60 basis points in a German bond market right now. Steve, all this talk about fiscal stimulus, the Treasury and how much they've done, how much more they'll do, the budget deficit, the debt load in America, 70 basis points on a 10-year. We broke south of that, Steve.
Yeah, no, this is really the issue. At least in the United States, there was some room for rates to drop. But if you take a look at this, the fastest economic decline that we've ever had in history, German bunds fell all of 15 basis points. That the bond market was essentially priced for crisis. Safe haven bonds, government bonds were priced for crisis going into this. So there was limited room for a further drop. And that's one of the issues here. It's one of the reasons why.
Steve Whiting there of Citi Private Bank. My producer tells me we've lost your audio, though I can hear you. Maybe our producer has lost the audio. Okay. We're going to arrange that and sort that out, Steve. Just stand by. I hope the listeners and the audience can also hear you as well. As we address that, Tom, let's talk about this market in the meantime, sir. In this bond market, treasuries rally. In the debt market, bunds rally. In Italy, keep an eye on what's happening in Italy. Yields are not lower. They're a little bit higher. And that was the test of this bond market. Would BTPs, would the Italian bond market start to behave like a sovereign?
Right.
This morning, they're behaving like a little bit of a credit.
Yeah, part of that was Ronaldo and the virus over at Juventus. I'm looking, John, at gold under 1,900 the ounce, $18.95, down $12. And again, I want to go back to oil. Riley, if you've got the chart, throw it up if you can. This is a 4-day, 2-day West Texas Intermediate, 39.55. So we're just revisiting back to where we were a number of days ago. But again, John, I'm watching the velocity tendency as well this morning. I think we've still got Steve Whiting with us here with Citi Private Bank. We'll continue to get back here. It's sort of like setting up for a dual debate tonight, folks. The technology of this right now. There's that chart on oil showing the quick reversion that we've seen. Steve, within a portfolio construction, you and I were weaned, and this is quantitative out of Baruch. I mean, Steve, you've got major chops on this. Does a 60-40 or a 60-30-10, does that math still work, or are we just set some new horizon?
This is a difficult period for asset allocation because you can have safety or you can have income. We used to have both, right, from that portion of a portfolio, right, that would offset risk. When equities fall, you could earn income and you could have a rally in the bond market. Here in this case, and we just mentioned this in the case with German bunds being as low as they are, you're getting neither of those things. What you are getting, though, is dry powder. that in the sense that if you have some portion of a portfolio set aside in assets that won't drop in price when you get corrections, that at least can be reinvested. But it does change the math of asset allocation. Right now, as you heard earlier, we're willing to take more credit risk. That's despite the fact that the U.S. corporate bond market has needed 2 macro bailouts over the last 15 years.
I mean, John, was it a week ago we were talking about the new Apple iPhone? What happened?
I think that was last year, wasn't it? The iPhone 12. Steve Whiting, a final question from me, just on policy. I know the team here at Bloomberg are working on a story at the moment, and I think it's an important one. This week is the IMF World Bank meetings, and I think what we've not seen enough of is what we saw a lot of in the last crisis, which is countries and economies working together. Everyone seems to have gone their own way. Why, Steve?
Well, I think we lost that along the way. It was very important for the last crisis that we actually had cooperative policy. We had a trade war in between. And I think that this crisis in many ways, I mean, the fact that even at a national level, we're not conducting COVID policy, right? So if you think about some of these massive differences in the handling of COVID, in the case of China, at least we can say they're using restrictions and healthcare policy to treat it. We're using monetary policy, right, to paper over this particular issue until there is a healthcare solution. But the fact that it is not even national in terms of the specifics of healthcare policy, so how would we expect to leap to an international global policy when we can't even necessarily handle it nationally?
Steve, fantastic to get your thoughts on a program, on policy and on the markets as well. Steve Whiting there of Citi Private Bank. And Lisa, this goes back to something we explored in the last hour about Asia and the outperformance we're starting to see there, the way they dealt with the virus compared to, say, Europe, the United States. And I think it leads to the next logical question, just in terms of the sequencing here. How much can that part of the global economy decouple from the rest, considering what we're seeing play out in Europe this morning?
And frankly, the answer is not tremendously, right? Because China is trying to become more of a domestic economy and depend less on exports. And yet you can see their exports increasing dramatically, and they're getting more dominance there as their production is able to gear up. But it's a really good question. I mean, I know the IMF came out. China definitely has the brightest prospects, but they too are going to experience the slowest growth in decades, John. So still very much hit by the global situation.
Let's get to the price action of this Thursday morning, shall we? Equity futures down 42. We're negative 1.2% on the S&P 500, breaking lower in Europe and breaking down in the Eurozone economy. That's the fear. Euro dollar, a break of 117, 116.94, down 0.4%. Tom, do you remember 120, the line in the sand?
Well,
ECB policymakers pushing back. The market's doing it for him now.
And John, you know what you do. You confirm over to Euro Yen. I'm typing that on the Bloomberg right now. You look at Euro Yen with a nice sharp drop here. Going to test a 122. That's a big deal. Strong yen, weak euro.
Coming up on this program, Chris Kotowski, Oppenheimer & Co. Managing Director and Senior Analyst. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. A beautiful morning in New York City. Good morning to you. Down 42. We're negative 1%. This is Bloomberg.
With First Word News, I'm Rishka Gupta. The chances of Congress passing a pre-election stimulus are all but gone. Treasury Secretary Steven Mnuchin is blaming politics. Mnuchin says Democrats don't want to give President Trump something to brag about in his campaign. Democrats say the White House never took the need for another stimulus seriously enough to push for a compromise. And Senate Democrats are all but powerless to keep Amy Coney Barrett off the Supreme Court. So they used their final day of questioning at the confirmation hearing to grill her about statements made by President Trump. Barrett declined to answer whether the president has the right to delay the election and an absolute right to pardon himself. New restrictions being imposed in London in an attempt to stop the rise of coronavirus cases. Londoners will be banned from mixing with other households indoors. The new rules start this weekend. London will soon hit an average of 100 coronavirus cases per 100,000 people. And sticking in the UK, British Prime Minister Boris Johnson told EU leaders he is disappointed by the slow progress of Brexit trade talks. Johnson says he'll decide after an EU summit this week whether it's worth continuing to work for a deal. Previously, Johnson had threatened to walk out today if there was no clear agreement in sight. Another sign of the impact the coronavirus is having on higher education. American colleges are seeing sharp declines in enrollment of new students this semester. A report says the number of first-year undergraduates enrolled fell 16%. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Welcome to That's Debatable, an interactive series on today's most pressing issues. The resolution this time, is it time to redistribute the wealth? Two perspectives.
Pointing to billionaires and saying we should take their money away is ineffective political strategy.
We have a choice in this country, either great wealth in the hands of a few or a democracy.
I'm John Donvan. Join us for That's Debatable, presented by Bloomberg and Intelligence Squared, Friday at 7 p.m.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
I think we will get more fiscal stimulus after the election, both in the lame duck session of Congress and in the new Congress, and that should help reduce credit losses until you get that surge in growth later on next year. And then when you get that, I think you get a steeper yield curve, which will also help financials. So financials are being treated as if they are victims of this this pandemic, when they're really operating pretty well.
David Kelly of JP Morgan Asset Management, the Chief Global Strategist, making it all sound very easy. This Thursday morning, good morning. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. Your price action, 1 hour and 12 minutes away from the opening bell. Equity futures are negative, down 1.2. We're down 42 points on the S&P 500. The pain is in Europe. The equity benchmark in Frankfurt, Germany, the DAX, we shave 380 points off the DAX, down by around about 2.9%. Tom Keene on top of the euro crosses, euro dollar 117. Look out at the Aussie as well in G10. That's where your underperformance is for the majors. The Aussie dollar down around about 1.33%. Those growth proxies in foreign exchange, Tom, breaking down.
Absolutely. Lots of breaching here of certain levels. As I mentioned earlier, gold $18.95 down $12. Under $1,900 an ounce, get your attention. And Euro Swissy under a 107. Stronger Swiss franc, 1.06984. It really gets your attention this morning. Right now, Christopher Katowski joins us with Oppenheimer, Managing Director, Senior Analyst on the banks, and he's got a varied and nuanced opinion here on the banks. Chris, what's the difference, the distinction between Morgan Stanley and Goldman Sachs?
Well, actually, I put them together. I put them more together than apart in the sense that, you know, compared to the ordinary commercial banks, they have a very small loan portfolio. So what's interesting about those companies is that they're benefiting from the very active capital markets and capital raising, right? So trading this quarter, and actually for each of the first 3 quarters, trading was up about 20% year on year. But when you know, for the banks, you know, I think the banks are oversold and people are overly worried about the credit risk in their loan portfolios. But however you feel about that, you know, basically Goldman and Morgan Stanley are going to miss that party for the most part, because, you know, Goldman and Morgan Stanley have a loan portfolio that is like between 1 and 1.5 times tangible book, or times their capital, whereas like most banks have a loan portfolio that's like 6, 7, 8 times, you know, their tangible capital. And on top of that, if you compare Morgan Stanley and Goldman, you know, they don't have a lot of credit cards. They don't have any small business lending. You know, Goldman Sachs and Morgan Stanley both basically lend to either wealthy people or to large institutional companies, whether they're public or sponsor-backed.
Chris, so is what you're saying that Goldman Sachs and Morgan Stanley are less well positioned for the upcoming recovery that we may see in the global economy, and that the likes of JP Morgan, Bank of America, and even Wells Fargo may be better positioned?
No, well, I would say, look, as long as we're in this kind of uncertain environment, I think Goldman and Morgan Stanley are absolutely the lower risk way to play financials, right? I mean, they can be the chicken's way of playing financials because you don't have a big loan portfolio. On the other hand, like if you heard that there was a vaccine that is safe and effective, if you heard that tomorrow, then you would probably do much better in kind of the beat up lending banks because they're down a whole bunch more, and you know they would be affected more.
Chris,
on the upside.
What's the catalyst for the rally in financials that so many people are expecting?
Well, ultimately, it'll be when they get to buy back stock again, right? Because the valuations are really trodden down, but you know, their underlying level of profitability is still pretty good. I mean, there's been some pressure. There's been pressure on bank earnings from interest rates coming down. And the other thing that we saw, you know, with the big banks is that, you know, people have paid their credit cards down like 12% since March. And, you know, credit card loans are obviously kind of the highest yielding earning assets that banks have. So that's all pressured revenues, right? But the good thing is, like, the bank credit quality has thus far been way, way, way better than anybody expected. So, right? So, I mean, the banks aren't in trouble on that front.
Chris, let's sum this up. We've had a bunch of bank earnings, as John Farrell mentions. We're going to move forward. Are we going to have more Eaton Vances? Is there a massive desire, too big to fail, super regionals, regionals, and on down? Is there a new need for scale, which simply means combinations?
I mean, it's long overdue, certainly in the banking sector. You know, I mean, we have an artificially fragmented banking sector because until the 1980s, you couldn't bank in more than one state. So compared to any other country in the world, our banking sector is just way too fragmented, and so that makes sense. I don't think you'll see a giant M&A wave near term. I think you'll see some. But I think it'll be still episodic and sporadic.
Chris, just a final question from me. How much are these names propped up by the fiscal effort down in Washington?
Well, actually, I think the much bigger impact is just that white-collar layoffs haven't been that big. And the thing is, if you look at, like, big bank credit card portfolios, over 80% of the borrowers have FICO scores over 680. So then that's roughly average. So, 80% of the borrowers are in the upper half of the income scale. And if you look at, unfortunately, the people who've gotten hit by COVID, it's mainly lower income people who are not bank customers. I think people really way underestimate how much the bank customer has moved upscale. I mean, it just, with a stress test and so on, you basically can't lend to the lower half of the income spectrum, and that's what's gotten hit. So I actually think people have way overplayed the importance of those programs. Mind you, the PPP, I think, kept hundreds of thousands of small businesses afloat when when lots of people, I think, in April and May were thinking, oh God, we just got to shut down. So I think
that's just a slight contradiction there, Chris, at the end of your response then.
Well, I think the PPP helped, but I think it actually, I mean, if you really look at, why has the bank's credit experience been so good? It's because basically, in a CCAR world, they can no longer really lend to lower income people. They have to lend to people of means.
Chris, great to catch up. Appreciate your time. Interesting perspective. Chris Kotowski there of Oppenheimer on some of these big names. Wall Street earnings, that is a wrap. Equity futures, negative 38. We're down a little more than 1%. We recover off the lows just a little bit, but it's a messy session as the fiscal talks break down. Look, we've been turning the volume up and down on the same song for the last 2 months. It's the same track. I've said that repeatedly. Hardly anything has changed. Tom, with 3 weeks, 2 weeks, 19 days to go, I imagine we'll hear more of the same over the next couple of weeks as well.
I strongly agree with you, John. It's a back and forth of this, but I would suggest the correlations here to disinflation today really get your attention.
Coming up on the program, Lindsay Piegza, Stifel chief economist. Looking forward to that chat right here on Bloomberg Surveillance.
Me gustaría decirle a los empleadores que fueran más humanitarios con sus trabajadores, que les hagan valer sus derechos. Y estábamos viviendo en dos casas, en unas 50 personas y en la otra otras 50. En cada casa había 5 habitaciones. En cada habitación había de 3 a 4 camas abarrotadas. Vivíamos de 6 a 7 personas. Un baño para cada habitación y una cocina para todas. Una vez que nos atendieron recibieron en el hospital. Al salir, nos avisó una compañera que ya nos habían reportado a migración. Gracias a Dios ahorita de salud yo estoy muy bien, pero en lo moral no estoy muy bien, porque a causa de esta enfermedad yo perdí todo, perdí mi trabajo. Yo creo que mi caso resulta un gran problema de cómo las personas migrantes estamos en riesgo de explotación por parte de los empleadores.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
It's Thursday morning, about 8:30 Eastern, which means one thing. Michael McKee will be with us in just a second. Equity futures down 39. We're negative 1%. With your data, here's Mike.
A lot of data today, John. Let's start with jobless claims. That's everybody's focus these days, even though I will explain in a moment, the numbers aren't necessarily accurate. Initial claims come in at 898,000. That's a significant increase from last week, 840,000. It's way above the 825,000 that we had, that the consensus survey said we would get. It's an increase of 53,000 on a seasonally adjusted basis. A non-seasonally adjusted, we go up to 885. That's an increase of 77,000. And you look at the pandemic unemployment insurance, that one dropped to 372. It's down by 91,000. So this is all basically new unemployment insurance claims. Total number of claims out there right now, 25,290, down 215,000 as people start to drop off the rolls because they've used up their unemployment compensation after 26 weeks. Other numbers out this morning. Empire Manufacturing, this is starting to tell us the same story maybe as claims, that we do see a slowing in the economy for the most recent month. This is an October number, comes out at 10.5. Last month in September, it was 17. We also got the Philly Fed today. Philly Fed goes the other direction, a significant increase there, 32.3 for the headline number. That was 15 last month. So make of it what you will. The employment index for the Philly Fed drops to 12.7, but the employment index for the Empire Manufacturing rises a little bit. So make of those regional indicators what you will. And then let's just quickly note that import prices rose 0.3%, which is bang on the consensus estimate, but 0.9% last month. So we saw import prices slow somewhat. We've seen the dollar gyrating around, and it is probably related to that.
But Mike, really the focus is on jobs. You said everyone's looking at jobs, and that really is the standout here. Much worse than expected in terms of the labor market picture. And the revisions also coming in weaker than expected. In other words, revising downward, giving more people on the unemployment rolls over time. The one bright spot is that continuing claims ticked a little bit below where people were expecting. Can you talk a little bit about how reliable this data is, about the potential distortions, and what we can hang on to in these numbers?
Yeah, the big distortion is in California, because California a couple of weeks ago shut down its claims processing in order to try to weed out fraud and try to get through a big backlog. They were shut down for 2 weeks. They've come back online, but the Labor Department says their numbers are still out of whack. And so for the next 2 or 3 weeks, they're using the same numbers that they've used for the past 4 weeks now, which is 226,179 jobless claims. That's about a quarter of all the jobless claims, and that suggests that maybe it is a little bit off there. So we really don't know what the total number of claims is. However, the change in direction is something that has got to be somewhat worrisome. And then we're keeping an eye on the idea of 26 weeks is how long you get in most states for unemployment benefits. People are running out of those. They're starting to move to the extended benefits that were put into the CARES package. And so we should see continuing claims continue to fall, but extended benefits rise, and they did this last week.
Michael McKee, one final question to you. I look at export price index. Folks, I don't look at import price, export price. That's like a McKee thing until it matters. And right now it really matters. We have a disinflation in our export price index. What does that signal, Michael McKee?
Well, the export price index up 0.6 better than it was, and so on a year-over-year basis, you're negative 1.8. That's also rising, but it's basically a function of the fact that there isn't a lot of demand for U.S. exports yet as the global economy recovers. Import and export prices are a small part of the overall inflation picture for the United States, but it does give you an idea of sort of where we're seeing currency alignments at this point.
Very good. Michael McKee, thank you so much. Greatly appreciate that. Our international economics and policy correspondent. Right now joining us, Lindsay Piegza, Stifel chief economist. Lindsay, on the back end of the GDP equation, as Mike and I were just talking, is export and import. What is the view 12 months forward of how our exports could advantage us, or is that a pipe dream?
I think at this point, it's going to be a very minimal contribution to the U.S. economy going forward for quite some time, as we do expect the global economy to remain very tepid, translating into very tepid demand for products, whether they're produced domestically or internationally. So I do think that trade right now is going to reflect the ongoing saga of weak global GDP, which we do expect to carry not only into 2021, but potentially much further into 2022 or beyond.
You know, I look, Lindsay, at the basics. So I got to get some numbers out of you. 12 months forward, what is your call on GDP?
I think we're going to struggle to get back to a 2% sustainable rate. And remember, 2% is not only where we were going into the pandemic, but this is the bare minimum that you should expect from a developed economy. 1% from productivity gains, 1% from population growth. There's your 2%. And I do think that going forward over the next 12 to 24 months, that's going to be our target. And we are going to struggle to reach that level of growth.
Lindsay, let's talk about the regional divergence. It's been a story for us all this morning. Asia doing better, China specifically, Europe doing worse, somewhere in the middle, the United States. Do you see any of those regions reconciling one way or another?
Well, it depends on the virus. Remember, this isn't a market crisis. This is a health crisis. So it depends on how we are able to control the spread of the virus and get the economy, the local economy, be that China or Europe, back into some sort of semblance of normal. Now, we have seen a resurgence of cases in Europe, which have led to further restrictions, further shutdowns. And of course, then by extension, this will continue to downplay any kind of recovery from a GDP or employment standpoint. And of course, that translates over to the US as well. If we see a resurgence in the virus as weather turns cold in the fall and towards the end of the year into the winter, it's very likely that we will see further restrictions or further safety measures imposed here in the US, which will very quickly dampen the modest recovery that we've seen in the very difficult. It's very difficult. And I would say that given the number of uncertainties and the unprecedented nature of the virus and the environment that we're in, it's not necessarily as important as pinpointing the precise level of growth or inflation over the next 12 to 24 months, but really understanding more the directional momentum of the economy, which we expect will lead to a very tepid, very bumpy, very prolonged path to recovery. So again, going back to the initial question, we don't see growth recovering anywhere near a robust 3, 4, 5% GDP pace anytime soon. It's likely that the U.S. economy struggles to crawl back to a more tepid 2-ish% pace.
I mean, Lisa, Lindsay, Lisa's aisle. Yeah, okay, Lisa, I got Lisa too. Lindsay, the issue here is you're talking less than 4% nominal GDP. I would suggest that's politically unacceptable. So do you just assume whatever the election, a massive stimulus like proposed January 26th?
Well, wait a minute. We were championing the ongoing recovery going into 2020, and the growth rate had slowed to 2% real growth. So I don't know if that's necessarily unacceptable. I think the bar of expectations for the U.S. economy has declined so precipitously that if we got back to a sustainable 2% level, that would be championed as a resurgence back to a recovery or a strong economy.
Yeah, I looked, Lindsay, finally at the claims at 800,000. We all agree it's unacceptable. What is your modeled unemployment rate for the United States of America?
For the year of 2020, I think we could get down to a low of about 6%. Going forward, I think it's going to be very difficult for the economy to maintain a level below that, as I do think the timeline for businesses to come back online, reconnect with employees, reconnect with supply chains is simply going to take time, even under the best case scenario. So I do think that the unemployment rate is going to be stubbornly around 5.5% to 6% for the foreseeable future.
Lindsay, great to catch up to get your thoughts. Important morning. Lindsay Piegza there, Stifel, Chief Economist. Some headlines coming from Secretary Mnuchin speaking to CNBC, just to bring you some of those headlines right now. We're going to keep trying to get a stimulus deal. The President determined to work on a larger stimulus deal. The Treasury Secretary will be speaking to House Speaker Nancy Pelosi a little bit later today, Tom. And just to fold this into the conversation we just had moments ago, many economists making the argument on this program that if we don't get that fiscal effort soon and quickly, that the damage done to potential growth in the future will be significant. The longer we stay below potential, the lower potential might be in the future. The words of Mohamed El-Erian to me a number of months ago, and a line that stuck with me, Tom.
John, I just did a word search. I don't see any Mnuchin headlines with the word McConnell in them. I would suggest that's probably a modest issue. I'm looking.
I would suggest and have suggested that is the issue, and that's why what you see from this administration.
A close position, one position, short position on euro, as you can see, at 117.10.2. Okay.
The political worry. Don't get me wrong, I think all sides want to make sure that this economy gets some stimulus and stimulus quickly, but the election complicates it. And Leader McConnell himself has acknowledged that. He's acknowledged the fact that that's why the two parties, the administration and the House Democrats, can't cut a deal. And the other issue, Tom, and you've touched on it, Leader McConnell has alluded to it a million times. There isn't the appetite to pass a $2 trillion bill in the Senate, at least not from Senate Republicans.
Well, there's no question that that's not there. To Lindsay Piegza's note, I'll point, the U3 unemployment rate, okay, it's 5, it's 6, maybe it's 8%. But, John, what is that modeled number with the numbers Michael McKee just gave us? And I'm sorry, you get up rapidly to 8, 9, even double-digit 10%.
Yeah, and the change, Tom, I would stress this time around, because of the conditioning through the last cycle, this Federal Reserve will wait a whole lot longer before they hike and lift off interest rates. Unemployment has got to go south, south, south.
Well, yeah, there's no question about lower for longer, and you see that here with what we're seeing in the tech companies and the new PE multiples as well. John, I got a note, curve flattening this morning. We're under 56 beeps. That's a big deal.
Where did Lisa go? Did she just leave us?
Is Lisa gone?
Did she abandon us? Was it you?
Yeah, it was probably me. Yeah, I'll take the blame for that.
Coming up, Vito Gaspar, IMF Director of Fiscal Affairs. From London and New York, Lisa stepping away for an important panel. Much more on that through the day on Bloomberg TV and radio. Neither do I, Tom, but Lisa's more important than us both. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Don't count on another pandemic stimulus package before the election. House Speaker Nancy Pelosi told MSNBC the two sides are far apart on worker safety, school funding, and a strategic testing plan. Meanwhile, Treasury Secretary Steven Mnuchin says Democrats don't want to give President Trump something he can brag about in the last weeks of the campaign. And Democratic presidential candidate Joe Biden raked in a record $383 million last month. That broke the mark the Biden campaign set the month before. The massive fundraising hauls have helped Biden and the Democrats reverse President Trump's one-time financial advantage. And Q-Song Lee is now the sole CEO at Carlyle Group. He recently sat down for his first major broadcast interview since taking over at the private equity giant. He discussed a wide range of topics, including why retail money represents huge potential.
This is going to be a big opportunity moving forward. I do think there's going to be an acceleration. I think it points to the fact that alternatives are really more mainstream than you'd think because of our performance and the alpha that our asset class can generate.
And we'll have more of that interview with Carlyle's CEO throughout the day. In France, President Emmanuel Macron has imposed a curfew in Paris and other major cities. That extraordinary step is part of a series of new measures aimed at containing the spread of the coronavirus. Rising infections in France have started to fill up hospital beds. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Worries about debt levels going up are not for now. For now, the biggest worry is that we don't do enough to support the economy until we have a durable exit from the health crisis.
The words of Kristalina Georgieva, the IMF Managing Director. Much more on the fiscal effort and the International Monetary Fund in just a moment. From London and New York this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. In about 15 minutes on Bloomberg TV, catching up with Dan Suzuki of Richard Bernstein Advisors, the Deputy CIO, Tom, as equities break down a little bit and the epicenter of that concern this morning over in Europe.
No question about that, John. Over in Europe, the challenges of this pandemic and, of course, the pandemic worldwide. Just to give some color to the data check, we deteriorate on futures. Negative 41 has become negative 43 rather, on SPX futures. Dow futures, negative 344. We're out two big figures now in the VIX, showing some of those tensions. I'm monitoring on a global basis. Euro Swissy, I would suggest, under 107 to a 1.06982. It is a time of year where we set our calendars. That always means Francine Lacroix and myself in Washington for the meetings of David Malpass's World Bank and Ms. Georgieva's International Monetary Fund. And one of the high points live in the atrium of the IMF is Vitor Gaspar with the International Monetary Fund. He is Director of Fiscal Affairs and, of course, steeped in the tumult of the economics of his Portugal. We're thrilled that Dr. Gaspar could join us for an update this morning. I loved your summary, Vitor. You went right to the heart of it, which is when private is on its back in a pandemic, it is public investment to the rescue. Why is this so difficult? Why is it so hard to commit public investment in democracies?
Thanks for having me, Tom. We do make a very strong case for public investment in the fiscal monitor. We argue that in moments of extreme uncertainty like that, which is caused by COVID-19, public investment allows for a bridge over the uncertainty and provides the private sector with opportunities for profitable investment. Specifically, we estimate that multipliers are elevated under the circumstances of 1% of GDP expansion in public investment in advanced and emerging market economies would lead to an increase in GDP of 2.7%, because it would motivate private investment to increase by 10%, and more importantly, private and public investment would lead to employment creation of between 20 and 33 million jobs, according to our estimates. Public investment is always difficult, Tom, because the payoff normally comes later. It's only when public investment affects potential output that the benefits come to fruition. And that takes time, and the political systems around the world are not patient.
I want to, in the time that we've got left, Dr. Gaspar, talk about the little g. There is a great assumption in our crisis with the expansion of fiscal deficits, the expansion of trade deficits in selected countries, that we will, quote unquote, grow our way out of this. How do you respond to that maxim?
So we do have, for the first time since the start of COVID-19, we have medium-term projections, so we can actually answer your question. We do see some permanent scarring in terms of the level of output, but not in terms of the growth rate. So basically, there's a permanent loss, but the growth rate regains. That is crucial for the public debt to GDP ratio going forward. We see this jump up in 2020. Public debt goes from 83% of GDP in 2019 to 98.7 at world level. It's a very strong jump up. But wait, Tom, in countries like the US or the UK, the jump up is even greater at more than 20% of GDP. But going forward, very low interest rates for long and the rebound in economic activity means that the contribution of the interest payments and growth actually helps public debt coming down. And there is also a correction in our baseline of the primary deficit. So the primary deficit comes down and the debt level, at world level, stabilizes at around 100% of GDP.
If I could fold one final question into what we've observed this morning in Europe, which is a real reaffirmation of disinflationary tendencies. Vitor Gaspar on the experiment of negative interest rates. How has that worked?
Look, central banks have for many years developed monetary policy strategies based on a monetary transmission mechanism that relies on interest rates. Now, when inflation is very low, when interest rates are very low, there are constraints on the traditional monetary transmission mechanism. That does bring additional uncertainty. We have less knowledge about the transmission mechanism under those circumstances, and that's one of the reasons why central banks around the world are conducting monetary policy strategy reviews.
I mean, it's very interesting. Vitor Gaspar there with a really important point. We have less information. I can't say enough about the 3 publications of the IMF, always at their October meetings. The Blue Book gets all the press, all the glory. The mathiness of the Green Book on financial stability is important. But the benchmark of this is the balance sheet as witnessed by Vitor Gaspar's work at the IMF on fiscal affairs. I urge any of you to consider that at the IMF as well. It is an extraordinary day in America. We have never seen this politically. In the heat of a campaign, the 2 candidates in 2 separate chairs on 2 separate networks with 2 separate, I guess, debates, maybe a debate, maybe a monologue, who knows? Maybe they'll touch on policy. We will address that with Jared Bernstein coming up on Bloomberg Radio, a chief economic advisor to Vice President Biden, and we will talk to him just possibly about what the policy is for. I'm really looking forward to this with Dr. Bernstein. He's been a good friend of the program over the years, and maybe we'll glean Biden policy and even glean Trump policy from Jared Bernstein. On the market, well, there's a shift. We've had a number of growthy days, even growthy weeks, and we reverse. Futures at negative 43, Dow futures negative 343. Even the NASDAQ comes down, well, a greater percent, 1.5% on NASDAQ 100 futures. The VIX now out to daily worst, 2.10. Big figures, 28.47. The dollar stronger. It is a risk-off day. Please stay with us through the day on Bloomberg Television, on Bloomberg Radio. Good morning.
around us, including the way we work and live, has been interrupted. Uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
From London and New York, for our audience worldwide, good morning, good morning. This Thursday morning, 30 minutes away from the opening bell, the countdown to the open starts right now. Equity futures down 42, we're negative 1.2%, and we begin with the big issue. New virus cases surging.
I am placing a new order to buy euro at 1.1692. Okay? Order placed to buy euro at 1.1692.
Seen it in March, this huge risk-off moves, and we are seeing the beginnings of it again. But hopefully we'll be able to avoid going back to full lockdown.
The more stringent the lockdowns get,
if the governments are going to lock down again,
forecasts are going to have to be revised down.
Governments are going to have to continue with their fiscal stimulus.
If there is a policy fatigue,
it's not about central banks mainly, it is about fiscal policy and other policies moving.
Then we're in a much more dire scenario.
Some of Europe's largest cities facing drastic restrictions, with new infections surging to record levels across the continent. France imposing a curfew for some of its biggest cities. Germany taking a series of piecemeal measures, and tighter curbs coming to the UK, banning London households from mixing with others indoors. Joining me now is Bloomberg's Guy Johnson. Guy, it's October 15th. I think the hope was that we wouldn't be dealing with this kind of thing deeper, much deeper into winter.
Absolutely, but as soon as people start shifting indoors, John, that is what is seeming to happen. We are finding ourselves in a situation where COVID cases are rising and rising rapidly. I think what we're doing is debunking any idea that we know how to handle this, that we've got it figured. There was this idea that kind of populated many of the conversations throughout the summer, that once we got to winter, we would have the therapies, that the hospitals would be better at treating this, that we would find a way through that wouldn't require the kind of onerous lockdowns that were required earlier on this year. That is certainly being put to bed here in Europe right now. It is not going to happen. The UK, for instance, London now at the second highest level in terms of the three-tier system that the UK is now operating. There are concerns that we could see Manchester, a huge area in the north, west of England, being put into sort of the tightest restrictions. We've already got the Liverpool area there. We've got York, we've got Essex being placed into tier 2. The whole kind of story is mounting towards the potential for a national lockdown, and Boris Johnson is not ruling that out at this point. But John, I think the message for markets to take away from this globally is that if we think we've got a handle on this, Europe is disproving that theory and disproving it really quite dramatically.
Guy, at the moment for me it's the battle between local authorities and national authorities. I know you can speak to that, not just in the UK, but in Spain, in Germany as well. Is that complicating things this time around?
Well, I don't think I've ever felt the UK this disunited, not just in terms of the constituent parts of the Union, so we're talking about Scotland and Wales and Northern Ireland and England, but also, as you say, John, regionally. There is huge uproar this morning in Manchester, huge concern and confusion as to what is happening. You read the local newspapers up there, the Manchester Evening News, and you look at kind of the front page there. Nobody knows what's going on, but there's kind of unanimity amongst local politicians, which happens very rarely because they're usually obviously divided by party political lines, on their condemnation of what is happening down in Westminster. And Matt Hancock, the health secretary, was in the House earlier talking about the local lockdowns, and he couldn't really put his finger on what is happening in Manchester. And I think that's just emblematic of what is happening across the country, not only this country, but countries, as you say, all the way across Europe, John.
Guy, looking forward to the coverage at the top of the hour in about an hour's time alongside Alex Steele as we continue this coverage. I want to touch base with the markets right now, 26 minutes away from the opening bell in New York City. Futures breaking down on the S&P 500, but the epicenter for the pain this morning very much in Europe, with the DAX, the equity benchmark in Frankfurt, Germany, down as much as 3% and change a little bit earlier this morning. In the bond market, there's the bid. In Treasuries, a break of 70 basis points on a 10-year, 0.69% on a 10-year yield. We come down 3 basis points. The bid into bunds, though, really gets your attention as well. We'll talk about that a little bit later. Dan Suzuki of Richard Bernstein Advisors pointing to signs of economic improvement, writing the following: the stock market already seems to have moved on from the pandemic. Most economic and financial indicators continue to suggest that profits are recovering from the depressed levels during the extreme lockdowns. Dan joins us now for more. Dan, there's more a constructive view from you in that line. I know it's a lot more nuanced than that. Just speak to what's playing out in Europe this morning and fold that into your current thinking.
Yeah, I mean, you certainly took out the part that was the positive aspect of my comments. I think, you know, what's clear is that there's been an extreme tug of war going on in the markets. And I think on one hand, you have the negative impacts of the virus, which are, you know, you're seeing that in Europe. But on the positive side, you've had this never before seen record stimulus. Now, I think what's the issue that the market's contending with right now, and particularly with regards to Europe, is that you're seeing the negative impacts of the virus actually gain momentum, while the positive impacts of the stimulus are actually losing momentum. So I think that's been in the cards for a while. I mean, if you listen to any of the experts, they've told you that it's going to get worse in the fall as temperatures drop and mobility picks up. And then we've clearly seen, you know, a lot of these countries come out with big bang approaches to stimulus, which are now, you know, slowing off of those extreme levels. So I think that's the issue that the market's trying to struggle with right now, among all the other uncertainties out there.
Dan, it's a huge issue. More restrictions across Europe, the UK, France, Germany, Spain, Italy as well. And as you point out, diminishing appetite perhaps to do what was done last time around, a worry about the price tag. And I'm trying to understand whether there should be a worry about the price tag right now. 10-year Treasury yields at 70 basis points. For all the talk about more fiscal stimulus, trillions here, trillions there, 70 basis points on a 10-year. In Germany, negative 60 basis points on a 10-year. Dan, do we have to worry about the price tag of doing more?
I think that policymakers should always be conscious of the implications of their policy, but I think that squabbling over sort of the details of you know, a few $100 million in the context of what's happening with our economy, it probably doesn't make a lot of sense. I mean, the reality is we basically probably overspent with a very blunt tool early on in the crisis, and I think that was actually commendable because we didn't know. I mean, we had to react fast, and the speed and the magnitude of that stimulus response was very impressive. But clearly, you know, there's room to be improved upon. The problem is you went from such a high number of stimulus, a magnitude of stimulus, and that's dropping off very dramatically. I mean, even if you want to say that things shouldn't be to the extent that they were, I mean, it's a little bit odd to say that should go from 100 to 0 where we're still in the midst of the pandemic.
Dan, I really want to get a market view from you as well and just fold in the way you see the world right now into your market calls. The worry for Europe, I think, is that the data, the economic momentum had already stalled going into this, and this will add to that. In the United States, sufficient sequential improvement. Will it continue in your mind, Dan, or will it just start to flatten out as we go into year end?
Well, I think a lot of what you're asking really speaks to what I mentioned earlier about the sort of the extreme tug of war, right? I mean, if you think about just the COVID part of this, this crisis alone in isolation, it's almost like a self-limiter. It's like a speed limit on the pace of the recovery. You know, the more that the economy opens up and recovers, the more you see cases rise, and then the more you have to shut down to sort of, you know, lock down those cases. So I think that, you know, you have that COVID impact, which is picking up steam. And I think that presents a very tricky time, a tricky aspect to consider adding risk to portfolios at this point where we're just starting to see those numbers pick up. At the same time, again, a lot of this comes down to the stimulus. If we do get stimulus support, clearly what we saw earlier this year when incomes were actually rising in the depths of the pandemic, not only rising, surging in the depths of the pandemic, if you get that type of stimulus response or even anything in that direction, I think that the recovery can continue to gain steam. But without that, we've already seen, I mean, you don't have to be a forecaster. You can just look at the data that we've got even this morning. When Empire Manufacturing slowed down, you had the jobless claims number tick up. And this has been evident in the data for weeks that that second derivative of the recovery is slowing. And I think that's a direct result of, you know, that tug of war push-pull that we were talking about.
So a question that's dominated conversations we've had on this show over the last couple of months is, where do you hide? Where do I go to find those risk mitigating characteristics when I see a day like today? Where do I go, Dan?
Well, this is, I mean, when I've been on your show in the past, I've been very adamant that I think that you shouldn't make one-sided bets on given sort of this extreme nature of this tug of war. I think you need to have stuff. I mean, what you read from my prepared comments were that profits are clearly recovering off of those depressed levels. So I think that people should have things in their portfolio that are going to benefit from that. But I don't think it should be a one-sided bet. I think that you should pair those with things that act as balance when you get moments like this, when you get the COVID pickup, when you get negative stimulus news, when you have uncertainty around the elections and the policies that follow. So I think that in our portfolio, the way we're doing that is owning cyclical assets that we think either have a very low risk to the recovery story. And I think a great example of that has been transportation companies, where, you know, regardless of whether you look at the US, you look at China, which is ahead of us, you look at Europe, you know, transportation, the shipping of goods around has been a very consistent part of the recovery, whether it was online or not, because you just got to move those goods have to get to your door one way or another, whether it goes to the store first or it goes to you. So you're still going to have to ship those goods. But at the same time, you know, owning things in the portfolio that act as balance, like gold, like defensive sectors that are less economically sensitive, which are out of favor right now, I think having that barbell makes a lot of sense.
Dan, smart as always. And I always enjoy catching up with you. Dan Suzuki there of Richard Bernstein Advisors. Let's get to the market desk with equity futures near session lows with your movers ahead of the opening bell. Here's Abigail.
John, well, with the NASDAQ 100 futures underperforming down about 1.5%, we're going to hone in on tech because big tech is really dragging this morning. Apple, perhaps the ultimate barometer of risk on, risk off, or risk appetite.
New position opened at 116.92 on euro.
Apple is poised for a weekly gain, perhaps a fifth in a row. So that might be the true story on the iPhones, matching the fundamental praise. Amazon.com headed to a second down day in a row after their Prime Day event has closed down. Let's see what the numbers look like coming out of that. Really plunging Fastly, the software company, down 30%. This after they have put up a bearish pre-announcement, cutting their revenue forecast, really surprising analysts and, as you can see, investors. And then finally, Roku cut at KeyBank, the bank there saying valuation is high, positive catalyst priced in, and there is a short interest. It seems as though those bears are winning this morning on Roku and perhaps some of these other tech names, John.
All round, it seems. All round winning for the bears at a moment this morning. Abigail, thank you. Coming up, the chances of Congress passing a pre-election stimulus package fading. That conversation coming up next with BTIG's Julian Emmanuel. Equity futures down 43. We're negative 1.24%. This is Bloomberg.
really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I'd say at this point, getting something done before the election and executing on that would be difficult, just given where we are and the level of details, but we're going to try to continue to work through these issues.
Fiscal talks breaking down 19 days ahead of the election, with President Trump trailing by almost 10 points in the real clear average of polls. Deutsche Bank saying the polls point to a nearly certain victory for Biden, writing the following: a Truman-style error in the polls may give Mr. Trump a chance given the electoral college system, but the reality is that unless the polls narrow into election day, a Trump victory would be the biggest error in the modern era of mass polling. Bloomberg Chief Washington correspondent Kevin Cirilli joins us right now. Kevin, Deutsche Bank doing some work on this, and let's pour cold water over the whole 2016 issue and the polling error, in inverted commas. It's important to recognise that on the day of the election, I think the lead that Hillary Clinton had 4 years ago was about 3 points, and in the end, in a popular vote, what was it, a couple of points for Hillary Clinton? So for the kind of error that we're suggesting here, you do need to go all the way back to something like 1948. It would be a big turn of events, Kevin.
Exactly. Look, I think that in terms of the lead that Biden has over Trump, comparatively speaking, from 2016, his lead is bigger than Hillary's was over Trump back in 2016. Meanwhile, President Trump and Democratic presidential nominee Joe Biden are going to have competing town halls tonight. Remember, they were supposed to have a debate, but that had been canceled. President Trump's will be on NBC. That begins at 8 p.m. Eastern, and then Joe Biden's is set to begin on ABC in the hour following. So an opportunity for both of the campaigns to speak to a national audience directly in a town hall format. That third debate in Nashville, Tennessee for next week still scheduled. They're moving forward with that. And meanwhile, from an economic standpoint, which I do anticipate will come up in both of the town halls, we just got words and headlines crossing the Bloomberg terminal that Secretary Mnuchin saying on CNBC that he is planning to speak with Speaker Pelosi today, and that they are still going to continue to negotiate on the fiscal stimulus front. But again, it comes after his comments at Milken virtually yesterday, in which he said that it would be hard to get a deal before the election.
Kevin Cirilli, great to catch up, sir. Thank you. Some more happy talk around the stimulus plan, with a difference this morning. Equity futures did not bounce off the back of the headline. Equity futures did nothing, maybe conditioned by the moves of the last couple of weeks. S&P 500 futures down 42. We're negative 1.2%. BTIG's Julian Emanuel saying markets are entering a period of historic uncertainty, running the following: if we've learned anything in 2020, it's that anything can happen and probably will. The election could have a clean outcome, and the virus stays contained, lifting the S&P to 4,000. The election could be contested, the Senate and House gridlocked, and stimulus an issue unresolved, driving stocks to 3,000. Julian joins us right now. So, Julian, when you read that out to clients and they turn around to you and say, thanks, Julian, a band of about 1,000 points, what do I do? What do you tell them?
Well, our view is pretty consistent here, John. When you look at the challenges right in front of us, and we're not even talking about the medium term, we're talking about the near term, a virus that's surging, a stimulus package that appears to be dead, essentially an election that, while it may be a Biden victory, the question is, will it be an uncontested Biden victory? And then number four, positioning. Positioning is about as aggressive as it's been all year, because for the most part, active managers fear missing the upside into year end. You put that all together, and we are defensive. We do believe that at some point you could challenge the 200-day moving average in the S&P 500, which is around 3120. And frankly, if the election is an unclean outcome, you could potentially move lower than that.
How are you expressing that defensiveness, Julian?
So the best way for us is to take some chips off the table. We think the high flyers, again, what we see on a day-to-day basis is the high flyers outperform on the upside and underperform on the downside, which is why the NASDAQ volatility index is around 10 points higher than the S&P volatility index. But in these stocks that have run, 100, 200, 300% year to date, it's right to trim some exposure there, particularly since when you look at a lot of those stocks whose earnings expectations next year cannot in any way, shape, or form compete with the growth that they've experienced this year, there could be valuation compression.
Julian, just to refine this argument a little bit, just to finesse it so I understand it a little bit more clearly, this isn't a call on the business cycle rolling over again. This is just a call on the price of the story right now?
It is ultimately, but I'll preface that by saying there are still elements that we need. Okay, we need this stimulus. The fact that politicians in Washington cannot come to an agreement is literally unconscionable, given the dynamics of the virus, given the pain that 10 million plus continuing claims to unemployment, business is struggling. The issue here is the business cycle isn't likely to roll over if you can bridge liquidity to solvency, and that requires more stimulus over the next number of months.
So many people might sit here and say, in that environment, I want to earn the expensive things. I want to own things like growth, the secular growth stories that did so well through the crisis 7 months ago. And one thing that I still don't think we've quite figured out, Julian, are the true secular winners. The likes of Apple, for instance, I still don't understand through much of spring and through much of this year whether that was a consumer staple or a luxury goods item supported by a huge fiscal action and checks into bank accounts of everyday Americans, Julian. Do you understand what it is?
Well, frankly, in stocks like that, and if you go back to the heart of the pandemic, consumer staples were the thing that people gravitated to. And so, in a number of these stocks, you really, it's sort of a win-win. It's a consumer staple on one hand, and it's a high technology company on the other hand. And we are sympathetic to that. And those shares have earned their performance this year. But when you look at next year, you have to ask yourself, are these valuations justified, number one? And number two, if we roll over economically, and as I said previously, without stimulus, we're increasing the probability that we roll over economically. Is there going to be more of the activity that drove the outperformance of these shares in 2020? Is there going to be more of that activity in 2021? We'd say if the economy rolls over, the answer is no.
So final question from me, Julian. The time horizon on this call, a move down to the 200-day moving average on the S&P. What's the time horizon for the call?
Well, frankly, the window of risk is certainly between now and Election Day, November 3rd, and then depending on the outcome of the election, likely to extend to Inauguration Day on January 20th, from where we think there'll be a very good buying spot for what could be a very positive 2021.
I have no doubt you'll be on this program telling us exactly when that time is. Julian, it's great to catch up, sir, as always. Julian Emmanuel there of BTIG. Coming up, the analyst action you need to know. That'll be next in our morning calls, and later we'll be catching up with Ken Leon of CFRA Research on the earnings wrap on Wall Street. Morgan Stanley the last out of the gate. That's all coming up next right here on Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Five minutes away from the opening bell in New York City. Equities breaking down 40 on the S&P 500. We're down a little more than 1%. The headline you all expected from Leader McConnell saying that the Supreme Court Justice vacancy does have the votes for Senate confirmation. Amy Coney Barrett is that individual set to fill that vacancy. That headline just crossed into Bloomberg. Apologies for that. I'll get to your morning calls now. We'll start with KeyBank downgrading Roku to sector white with a price target. Without a price target, the analyst saying investors have priced in the positive fundamentals following recent gains. Bank of America upgrading Sonos to a buy with an $18 price target. The analyst cited the stock's valuation and encouraging demand signals. And finally, Guggenheim downgrading Mondelez to neutral with a $60 price target. The analyst seeing little upside with the company benefiting less than its peers from the pandemic. That stock down by 0.8%. Up next, the opening bell and rounding out earnings on Wall Street. This is Bloomberg.
Ada 3 kelompok pengungsi tersebut yang sudah berpencar arah. Kemudian kami dari Polsek Banda Sakti berkoordinasi dengan perangkat desa Kampung Jomblang melakukan upaya pengumpulan secara persuasif serta minta tolong kepada warga. Alhamdulillah warga yang terpecah semuanya berkumpul.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it'll take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacqua.
Valuations, particularly, sort of technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
23 seconds away from the opening bell in New York City. Equities, some weight to this tape. We're down 43 on the S&P 500, negative 1.24%. Your underperformance coming from the NASDAQ, down almost 200, negative 1.66%. Fiscal talks breaking down. That's the story in the United States, the story of Europe. the economy could be breaking down again. Extra restrictions on key economies across the continent responding to another surge in COVID-19 cases. In the bond market, yields come in 2 basis points to 0.7% on a 10-year. We come back a little bit there. In the FX market, euro-dollar a break of 117, 116 and about 90, down 0.4%. And there's the move in crude. It's ugly. WTI back with a 39 handle, $39 and around about 50 cents. We come in about 3.6%. That is the cross-asset price action this Thursday morning. At the market desk with your movers, here's Abigail.
John, it's certainly a risk-off morning, as you just illustrated. And beyond the mega-cap tech names such as Apple and Facebook and Amazon, mega-cap internet as well, trading lower. This year's highest flyers, high flyers, are dropping as well. Really the risk, exemplifying the risk-off tone, although Zoom now catching a bid. But Tesla, the NASDAQ 100's top stock on the year, up 450% of the year, down 2%. Investors wanting out of that. Zoom, the second best stock on the year, had been lower in the pre-market, up just slightly, a tiny bid there. And then take a look at NVIDIA, the chip maker, lower, and JD.com, the fourth best stock for the NASDAQ 100, up 130%, also lower. So investors mainly want out of risk on the day. And of course, a piece of this is wanting stimulus and not seeing strong signs out of DC that this will happen. But of course, the resurgence of the virus. And if we take a look at the truly sensitive stocks to the virus, such as the airlines, the cruise operators, and some of the energy companies, we see solid declines there. The airlines, interestingly, yesterday had outperformed, suggesting that maybe some sort of skinny deal around airlines stimulus would get done. But today we see American Airlines down 1.3%, Carnival down 1.5%, and ExxonMobil is down as well, down 1.4%, in sympathy with oil. That big decline in energy right now, the worst sector on the morning, down 1.8%, John.
That's the worst, but every single sector negative this morning. Abigail, thank you. 2 minutes into the session, every single sector is in the red. At the top of the pile, as Abigail points out, energy outperforming, relatively speaking, real estate. The S&P 500 down by around about 1.2%. Moving to the financials, the banks, Morgan Stanley edging lower along with its peers, despite reporting another impressive quarter. JP Morgan's David Kelly making the case to own the banks.
Financials are being treated as if they are victims of this pandemic when they're really operating pretty well. I'd rather own financials, to be honest, because I have to have more than a 12-month view. I'm not going to try and time this thing. I think that's crazy.
Bloomberg Sonali Basak listening in on the Morgan Stanley call. She joins us now for more. Hey, Sonali.
Hey, John, listen, these banks just can't catch a break. You have Morgan Stanley here beating on all the major business lines, fixed income, equities trading, second biggest fixed income trading on quarter on Wall Street. But at the same time, investors want a story. Right now on the conference call with investors, they're explaining the E-Trade deal, what it might add to them. They're explaining that it might add a little bit more to its cost base while they finish through integrating the deal. Remember, they've already pursued another deal with Eaton Vance. So with a cost base above 70% and an expense ratio, people are going to want to see some pressure there on that expense line in other ways. Goldman pointed to automation yesterday, but for Morgan Stanley, we'll see what that means. They said they were able to save some costs through this pandemic, but again, investors are looking hard for a story. Some of that might come through more equity underwriting, through more debt underwriting, but of course, with an election around the corner, that might create some uncertainties ahead for all of those markets, and we aim to touch on it a little later in a half an hour with Morgan Stanley CFO John Pruzan on this network.
Look forward to that. Does Sonali get to rest now? Do you get a day off?
No, we don't. No, we don't. There's more to look forward to, John. Keep your eyes peeled because we will be going right over to the buy side to keep an eye on Apollo and Blackstone, because guess what? Those debt businesses are what's taking share when the banks are going to be pulling back.
Non-stop, Sonali Basak. Sonali, thank you. Appreciate it. CFRA banking analyst Ken Leon remaining bullish on Morgan Stanley despite all the uncertainty, running the quote the following. Morgan Stanley fits the criteria of finding strong enterprises during COVID-19 despite near-term uncertainties in the general economy. Its top-ranked wealth management franchise offers stable recurring revenue and cash flow. Ken joins us now on the phone for more. Strong buy on the stock, $60 price target on Morgan Stanley. Ken, great to have you with us on the show. What did we learn this morning from the bank?
Morgan Stanley's on the right side of the world, which essentially is solid businesses that are benefiting from wealth creation, the knowledge industries, the ability to be really a key stakeholder in the growth of the economy. The large banks that have reported this week are on the other side, which are facing several quarters of really low rates, no steep yield curve, challenges in terms of credit loan losses. So Goldman Sachs and Morgan Stanley are just in a great position along with asset managers and those financial service companies that are benefiting from the knowledge industry. Morgan Stanley, I think, tremendous strategy acquiring E-Trade, Eaton Vance, everyone, there's a frenzy for asset managers. Everyone strategically, Goldman, Morgan Stanley, BlackRock, are looking to be a player for mass market, high net worth and ultra high net worth. So you essentially have to fill in each of the parts of the table. But I think Morgan Stanley is going to be a great investment over the next 1 to 3 years. There's a lot of accretion from these acquisitions. And again, there's no worry. You know, it's almost going to be like waiting for Godot. When are rates going to go up? It may be 2 or 3 years out. So net interest income, which was down, you know, anywhere 17, 20% for Bank of America, Wells Fargo. These are really steep challenges on the other side of the world. So when you think about investing in financial sector, there's definitely a deep chasm here between those who can benefit from a growing economy in time and those, you know, still at risk for low rates.
Ken, just in terms of those at risk to low rates, can you walk me through, and I appreciate the argument around fee-based recurring revenue for the likes of Morgan Stanley. I think everyone does. For the other banks, though, how dependent are they still on just traditional spread lending, borrowing short, lending long, and how much has that diminished in the last 10 years or so?
Well, it diminished in the last year, you know, when, you know, the Fed bringing rates down to practically zero.
No, sure, Ken, sorry, just let me jump in and I'll finesse the question if you don't mind. I just mean how much have those companies actually changed the business model so that they are also more reliant on fee-based recurring revenue and moving away from the old side of just spread lending? How much have they moved away from that, the JP Morgans, the Bank of Americas, etc.?
I think, you know, maybe 5-10%. JP Morgan's 45% of total net revenue is net interest income. The other banks, B of A, Citi, and also Wells Fargo, it's still 55%. They need volumes because if you have low rates, the only other part of the equation to get improved net interest margins is going to be volumes, and that's driven by loan activity, which is expected to be pretty spotty for the next 12 months.
Ken, always smart. Just wanted to get that question in there. Brilliant to catch up with you. I know you're super busy. We'll let you go. Ken Leon there of CFRA. Earnings continuing to beat expectations with the latest quarterly reporting season just a few days young, and the S&P on the cusp of another record high. There are questions over what is priced in. Bloomberg's Scarlett Fu joins us now for more. Hey, Scarlett.
Hi, John. Yeah, well, what's priced in are low expectations, but an improvement off that base. The question is, how resilient are these companies? Now, looking ahead, thematically, we get the start of big tech, both legacy companies and the mega cap tech names, also companies that give us a more direct read into the state of the consumer, and a couple of energy names as well. Here's how it all plays out. Now, the pace ramps up next week and then peaks at the end of October. Next week, 88 companies in the S&P 500 report, including Microsoft, Amazon, Procter & Gamble. They rank among the S&P's 10 biggest names, more than $8 trillion in market cap. Remember, the big banks that reported this week have a high profile but carry less heft when it comes to market value. In the final week of October, almost $12 trillion worth of companies report, including Apple, Alphabet, and Facebook. They make up 3 of the 5 biggest members of the S&P. And the backdrop here is that we're still in an earnings recession. Analysts expect third quarter profits will fall at least 20%, better than the 33% plunge we saw in the second quarter, paving the way for further moderation, looking at a 14% drop in the fourth quarter. And by 2021, the comps get easier and we'll see a return to EPS growth. But there's a lot of headwinds to work through in the meantime. No fiscal stimulus and a possible second wave. The takeaway here, though, is we are seeing sequential improvement. And for the first time since 2018, consensus EPS estimates were revised higher in the 3 months leading into the reporting season. According to Gina Martin-Adams over at Bloomberg Intelligence, the third quarter earnings season may mark the first opportunity for companies to guide expectations now that most global economies are functioning. But investors will be very quick to punish those that don't have the ability to get through it. John?
Scarlett Fu, thank you. All the companies lining up to report over the next couple of weeks. Full coverage right here on Bloomberg. I believe in about 2 weeks' time. we do get the earnings from Apple, October 29th. Looking forward to that. Equities down by a little more than 1% on the S&P, much more so on the NASDAQ. At the market desk with your movers, here's Abigail.
Well, John, we do have those major averages slightly off the lows, but nonetheless, you were mentioning that underperformance for the NASDAQ. Let's take a look at the big drag there. And of course, it has to do with mega cap tech and internet. Apple and Amazon, the two biggest point drags on the S&P 500. Nothing new really being reported on either of these companies. So a barometer of the risk-off tone around both the squashed hopes right now, at least for stimulus, and fears around the virus. As for the percentage movers, take a look at Vertex Pharmaceuticals, headed to its worst day since 2007. This after the drug maker has discontinued a lung and liver drug, which is going to also repel the new leg of growth that some have been hoping for. And then Fastly, down 30% at this point, after the software company pre-announced the downside, cutting their revenue view, really taking the street and traders by surprise. To put all of this into perspective, though, John, Apple right now on the week is higher on the week, headed toward its 5th up week in a row, although it's going closer toward even. Let's see whether or not those Apple bulls over the longer term can hang in, or these near-term bears are going to take over. Certainly those bears are present on the day, John.
Abigail, thank you. Just to bring you some breaking news quickly. Senator Harris, halting travel after an aide of hers has tested positive for COVID-19. Vice presidential candidate Senator Harris halting travel after an aide of hers has tested positive for COVID-19. The Biden campaign saying 2 individuals have tested positive. Campaigning in 2020, difficult. Just a couple of weeks, in fact, 2 weeks to the day almost, since the President of the United States also contracted COVID-19, or at least tested positive for it. We understand that Senator Harris, vice presidential candidate on the Biden ticket, halting travel after an aide of hers has tested positive for COVID-19. The Biden campaign saying 2 individuals have tested positive. More on that still to come. From London and New York, this is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Welcome to That's Debatable, an interactive series on today's most pressing issues. The resolution this time, is it time to redistribute the wealth? 2 perspectives.
Pointing to billionaires and saying we should take their money away is ineffective political strategy.
We have a choice in this country, either great wealth in the hands of a few or a democracy.
I'm John Donvan. Join us for That's Debatable, presented by Bloomberg and Intelligence Squared, Friday at 7 p.m.
$14 minutes into the session, here's your price action, down 0.9% on the S&P 500. The underperformance, mild underperformance, coming from the NASDAQ. We're down a little more than 1% there. I want to bring you some breaking headlines in the last couple of minutes. It comes from the Harris campaign, the Biden campaign. Senator Harris, vice presidential candidate, halting all travel after an aide of hers had tested positive for COVID-19. The Biden campaign saying 2 individuals have tested positive. The new headline that we have in the last couple of minutes, though, this is probably the important one for Senator Harris and the Biden ticket. Senator Harris was not in close contact with these individuals, but still halting travel in the last couple of weeks of an election campaign. Kevin Cirilli, I understand, is running to the camera down in Washington, D.C. to bring us the latest on that. We'll get to Kevin in just a moment. I want to turn to the economic data. Initial jobless claims out a little bit earlier on, unexpectedly rising, hitting its highest level since August. Dallas Fed President Robert Kaplan weighing in on all of this over the last couple of weeks. He is not all for what they've been doing on fiscal stimulus recently. I want to bring in Michael McKee for a little bit more on this. Good morning to you, Mike. Just walk us through the economic data and what you're hearing from the Fed speak.
Well, the narrative, John, has been that the economy is slowing. It has been slowing since summer, and the data we get today generally tend to support that. The jobless claims numbers up by 53,000 on the month, and that does suggest that my microphone fell off, so I'll put that back on. That does suggest that the economy is slowing as companies, people come back to work and find maybe their jobs weren't viable anymore, and of course we had a lot of layoffs in the airline industry over the past week or so. The Empire Index in New York also falls to 10.5 from 17, shows expansion but a slower pace, while the Philadelphia Fed doubles, gets better. Though the COVID numbers are better in New York than they are in Pennsylvania, so make of that what you will. The other aspect of it is from the Fed at this point. You have to look at comments from Randall Quarles last night, the vice chairman for supervision. Now, that's the jobless claims numbers without California in there, because California has halted their new numbers, and you can see the trend is still the same, all flattened out. But I want to talk about this Quarles thing because this is important to the markets. He suggested that perhaps the Treasury market is so big now, the Fed cannot stop QE even after the economy starts growing again. Here's his quote. It may be that there is a simple macro fact that the Treasury market being so much larger than it was, that the sheer volume there may have outpaced the ability of the private market infrastructure to support stress of any sort there. The Fed has argued that it went into the markets in March to relieve stress. If they get out of the markets, stress could come at any time. So Quarles, who emphasized he hasn't made a decision yet, thinks that there is a possibility the Fed can't stop QE, that the market's so big now they need to continue to be an active participant, which would have major implications for trading treasuries.
I think we've already got those major implications right now. Mike, fantastic to get your views on the program. Thank you, sir. I want to return to that breaking news in the last 10 minutes or so. It comes from the Biden-Harris campaign. I understand Kevin Cirilli is ready to talk to us now down in Washington, D.C. Kevin, what are you learning, sir?
Two staffers to Senator Harris, the Democratic vice presidential nominee, have tested positive for COVID-19. She will halt all travel through Sunday and will resume to the campaign trail on Monday, according to a statement from the Biden campaign. Senator Harris writes in her statement that she has not had direct close contact with the two individuals who have tested positive for COVID-19 as defined by the CDC. We should note Senator Harris has kept an aggressive campaign schedule. She has also, of course, been attending the Senate Judiciary Committee hearings as it relates to Judge Amy Coney Barrett. But again, she is halting all travel through Sunday. According to the statement, they learned late Wednesday evening, New York time, that two staffers on the part of the vice presidential nominee's entourage, so to speak, political entourage, had tested positive for this, and that she will halt all travel through Sunday. Democratic presidential nominee Joe Biden, as well as has not been in close contact with either of these individuals, according to the campaign. He, of course, is set to appear at a town hall tonight that will be broadcast on ABC in about the 9 o'clock p.m. Eastern New York hour.
Kevin, thank you. 19 days to go. We understand Senator Harris, the vice presidential candidate, tested negative for COVID-19 yesterday. That coming from a campaign statement. No doubt she'll be getting tested again today. The latest from Washington at the moment. I want to bring in Brian Nick of Nuveen for more. Brian, I won't ask you about that. I'll ask you about this market, though. Two competing forces at the moment, not even competing, complementary to the risk-off scene we're seeing in equity markets worldwide. Fiscal talks breaking down as if that should be a surprise. Apparently it is for some. On one side of the Atlantic, on the other, more restrictions. How do you process that news this morning, Brian?
Yeah, I think it's interesting to see sort of the juxtaposition here, because I think the fiscal stimulus is probably ample in Europe and in the UK. I think they've done enough to support the economy through the restrictions. And if you recall back in June and July when we had the surge here in the US, a lot of those CARES Act provisions were still in place. We're still seeing enhanced unemployment benefits. We still had the PPP going. Now we don't have those things. So we don't know, in the event that there is a large increase in the virus here in the US, what that's going to mean for an economy that's not being as well supported as it was. I think certainly the markets have been at least allowing themselves to be held hostage to the stimulus talks. We're not expecting to see much, if anything, out on stimulus until perhaps the middle of the first quarter of next year. And that makes the next couple of months pretty precarious for the markets.
It's interesting, isn't it, that a couple of weeks ago, the big fear was a contested election. Now I think the big fear has to be a divided government. Divided and this market will fall, Brian. I'm sure that's going to be in Southside research for weeks to come now, because if we don't have one wave, one colour or another, do you anticipate some real tension going into year end over the fiscal effort?
Yeah, this is a big risk. I think status quo, if we get a status quo outcome in the election, I think they probably pass something in the lame duck, because there's just no sense that anything else is going to be coming that's going to change the game. If we get an arrangement that looks more like, say, post 2012 election, where we get that austerity package, and the formula for austerity in the United States has been Democrat in the White House, at least Republican partially controlled Congress. And that's not what we need right now in terms of an economic program in the U.S. So I think it remains to be seen if, there's a slightly higher chance in some of these kind of polling models and betting markets that Joe Biden will win the presidency than there is that the Democrats will take the Senate. And that gap, I think, represents probably some near-term risk for the markets, because it would be so uncertain come January what could actually pass through that kind of arrangement.
Where in this market do you go to find risk mitigation characteristics for your portfolio, Brian? Where'd you get it?
Yeah, so in the equity market, it's tough, because we do think that eventually, as stimulus arrives, which I still think is the base case, that should be good for the reflation trade. So some of the areas we saw last week, a more broad-based rise in equity markets led at least modestly by cyclicals. But that looks precarious if we're going over the next couple of months where the economic data starts to get worse. That trade's not likely to perform well. We may take a step down or two in terms of risk, moving into, say, parts of the credit markets, even high-yield credit, to get some income, try to bank some of those returns in the form of interest payments, as opposed to waiting for multiples to continue to rise. So one thing that we continue to be focused on is just where in a portfolio you can get income from. Certainly the equity market provides part of it, but I think also the credit markets, to us, look reasonably priced for the risks that we see ahead.
Brian, always great to catch up. Sorry to squeeze the time just a little bit. Brian Nick there of Nuveen. Thank you, sir. The breaking news in the last 10 minutes or so: Senator Harris, vice presidential candidate on the Biden ticket, halting travel after an aide tested positive for COVID-19. We understand the senator tested negative herself just yesterday. The plan, according to a statement from the campaign, is for Harris to return to in-person campaigning this coming Monday. Keep an eye on the headlines coming out from Washington, D.C. That's the latest from Washington. Up next on this program, the trading diary, the market-moving events you need to be watching going into the weekend. From London and New York, with equities down and down much harder across Europe, this is Bloomberg.
Uninterrupted service is peace of mind. Juicy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
second half will be a lot stronger than the first half in China. We're heading to what we call the golden season of auto sales.
We are very confident, we're going to have another big growth, 2021 versus 2020.
We did not see people kind of holding back.
Chinese customers are into, right now, buying individual mobility.
Twenty-five minutes in, equities coming back a little bit, down 0.7% on the S&P 500, down 0.8 on the Nasdaq. Over in Europe, that's where the pain has been, down 2.4% still on the equity benchmark in Frankfurt, Germany. The DAX down by almost 2.5%. That's the story in the market. Let's get to the trading diary. What you need to be watching through this week: President Trump speaking at a campaign rally in North Carolina at 1 p.m. Eastern. Minneapolis Fed President Neil Kashkari discussing the outlook for the U.S. economy at 5 p.m. this evening. Then at 8 p.m., replacing the second presidential debate, President Trump and Joe Biden holding competing televised events. And finally on Friday, closing out the week with the biggest data point of the week, U.S. retail sales. 26 minutes into this session, equities lower, recovering slowly. This was the countdown to the open. For our audience worldwide, catch me on Twitter at FeroTV. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive.
I'm placing a stop on profit for position I have on euro at 116.94. Okay. Stop on profit place at 116.94.
When we should.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster.
Position closed at 116.94. We have 200 pounds in profit.
Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off. These guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself.
¿Dónde vive acá? En la parte de...